Okay, I think we have critical mass and we will get started here. People are still signing in, and so we'll welcome them. My name's Ian Campbell. I'm Vice President of Operations at PACICC. I'm the staff lead for the Risk Officers Forum, and I'm your moderator for this afternoon's broadcast. We're very excited with the sign up for this event. We've got close to 200 people on the line, or we will have, from 80 companies across Canada. So welcome everybody, and welcome if this is your first time joining our broadcast. I'm going to ask my colleague Grant to please advance on to the next slide. The agenda for today, we're going to look at some housekeeping. Oops, I'm sorry. The agenda, I'll begin with some housekeeping items. Then we're going to welcome our CEO to say a few words of welcome, and then go through 3 sessions, a keynote speech from OSFI, a panel session on model risk, and then a panel session on operational risk and resilience. And then we're going to close the broadcast with looking ahead at the next events with our Risk Officers Forum, and the next one being our May 19th webinar. So in terms of housekeeping items, the next slide, if I can ask Grant. We're using the MS Teams meeting platform, and I think you're all familiar with how this works. So if you have, we want our session to be very interactive, collegial, conversational. So if you have a question or a concern or a comment, please use the little icon, raise your hand. We will recognize you. There's a bit of a process. We have to recognize you as a speaker and then unmute you, and we can put on your video as well. But ask your question or your comment, and then we'll mute you again and move on with the broadcast. But we want to receive your questions and comments in real time. When you have a highly competitive industry like ours, it's important that we pay homage to the Competition Act, the antitrust compliance still in effect throughout the broadcast. We're not getting together secretly here. This is an open forum, all members welcome, and there's not going to be any secret talk about business strategies. The meeting is being recorded, you'll see, so it will be placed on our website for future rebroadcast, and the slide decks that you're going to see today will be made available to all people, attendees and non-attendees, after the broadcast. And again, I'm going to close, as we always do, with a satisfaction survey. You'll be receiving that tomorrow. And we invite your questions or your comments, and they help to make our broadcast that much better every time. So something I want you to know, a colleague of mine working this for the first time, Grant Kelly, has been signed on to advance slides and do all the background work. So if things go really, really well today, Grant is largely responsible, and if things go horribly wrong, again, I want you to know Grant is largely responsible for this. So now I'm going to call on our President and CEO, Alistair Campbell, is going to say a few words of welcome. Grant, if you could advance on to the next slide. And there's Alistair, and you're unmuted, Alistair. So let's please welcome our members today, and then I'll take it back and introduce our first speaker. Thank you.
Thanks, Ian, and welcome all. Very excited by the agenda that Ian and his risk advisory group have curated for us today. So I'm not going to take too much time before we get to the meat of the session, but I did want to use this platform and this opportunity to give you folks a quick update as to some of the work we're focusing on at PACICC this year. Our priority for last year and a portion of this year has been doing desktop simulation exercises with key regulatory partners. And so we have already completed our first desktop simulation of a distressed insurer scenario with the Autorité des Marchés Financiers in Quebec. And we are in the middle of one with Jackie Friedland's team at OSFI now, which is continuing to unfold. I'm part of that experiment, so I don't quite know where it will end up, but it is already very clear that OSFI is learning some useful lessons, and we're learning some useful lessons, which will help ensure that we've updated and upgraded our contingency planning so that if and when the worst case scenario unfolds, we are properly organized to partner effectively and to do our best to honor our mutual mandates, protect policyholders, to minimize the cost of the insolvency and protect the reputation of the financial services system, which we're all part of. So really interesting work, and very grateful for the deep engagement of particularly the independent directors of the PACICC board who've been doing a ton of work on that. Our priority issue for this year is a review of the scope, scale, and uses of our compensation fund. So just to remind you folks, we have about 60 million in the bank. How did we get it? It was formed through contributions from the industry in the form of a capital levy over 3 years in 98, 99, and 2000, 10 million a year, allocated by direct written premium on a formula. Since then, we've invested it very prudently and very focused on liquidity for obvious reasons, and that's how it's grown to the 60 we've got today. We've done some pretty comprehensive analysis that suggests that might not be adequate to meet the reasons the fund was originally created, which is to respond very rapidly for the refund of unearned premium to the many affected policyholders after the bankruptcy of a member insurer. So we've been doing some modeling as to what would be an appropriate number, and we've been doing some thinking about what would be the best way to ensure that we have the financial capacity we need without distorting the industry or accumulating additional unnecessary pools of capital on top of what is already a well-capitalized and reinsured industry. And so our board is having a strategic planning session in June. We're going to present some scenarios about that. Last year, I would have given you an update on the process we engaged in to explore purchase of reinsurance on behalf of the industry. We have now made some progress in negotiating what might be the terms of a standby line of credit as an alternative to reinsurance and as possible supplement, complement, or replacement for capital increases. And so those will be the items that we table with our board in the strategic planning session, and may well come back to the industry with some direction before our next board meeting in November. Last item, just very quickly, our priority issue, permanent priority issue until it's fixed, is the need for some form of federal backstop mechanism to address the worst case scenario of the megaquake in BC or the Montreal-Ottawa corridor that overwhelms the capacity of our well-capitalized and well-reinsured industry. In the last few months, we've been working very closely with the people at ICLR and at IBC. And in the last few weeks, we have been part of presentations to Finance Canada with what is getting really close to a holistic package solution that would tackle the key stakeholders exposed in that worst case scenario: policyholders, uninsured people, government and their contingent liability to deal with underinsurance or uninsurance in the industry. And so we really feel as a group that's been involved in developing these scenarios that we are now producing some very meaningful and serious ideas that could be drawn upon by Finance Canada to get to the point where there'd be some options for a minister to consider. And so probably more progress on this file below the surface than we've had in a long time. And looking very much forward to providing more meaty and comprehensive updates on this, ideally by the fall. So with that quick summary on the work we're cleaning up from last year, the work we're focusing on this year, and the work we're focusing on until we get to a yes on Quake. That's the PACICC story in a nutshell. Ian, I'll throw it back to you to introduce our special guest star for the first session.
Excellent. Thank you, Alistair. Since 2017, we've used our first Risk Officers Forum meeting of the year to invite in OSFI to give us kind of a spring check-in on current industry issues. And of course, everybody knows they do the risk management seminar in the fall, but this is a chance to kind of update issues in the interim. And this is Jacqueline Friedland's second time appearing, and you're getting extra value today because when I first invited Jacqueline back to speak, she was Senior Director, P&C Insurance Group, the Insurance Supervision Sector, and she is now Executive Director, Risk Assessment and Intervention Hub. So there is extra value to what she's going to say. This might be the last time we hear from Jacqueline. She's just a meteoric rise, so we're kind of sad about that, but hopefully not. Anyway, I'll throw it over to you, Jacqueline. They want to hear from you and not me, so welcome and take it away. Thank you.
Thank you. And I certainly hope I'm still invited back to speak and share my thoughts and ideas with you. Okay.
Absolutely. Thank you.
Thank you. And I think Grant will progress my slides. We can just start with the cover one for the moment. It's great to be here virtually at this forum again. And while I certainly miss seeing people in person, I do see tremendous advantages of virtual sessions such as this Risk Officers Forum, and that we're able to reach out and provide access to important messages and continuing learning opportunities to so many. It seems that every year our industry and our world are challenged with the existential risks that offer inflection points for history. As risk managers and as regulators, we have come to expect volatility and uncertainty as part of our planning, and thus we see the need to become increasingly more agile, not only in our work, but also as human beings as we continue to build resilience. There we go. Excellent. So we're on slide number 2. Terrific. So this has a discussion outline. Since my remarks at this event last year, new risks have arisen while older ones remain, and our world continues to change, at times significantly, as we've experienced within the last few months alone, disturbing events in Ottawa and Ukraine, and now we're deep in the midst of a 6th wave of COVID across Canada. Last year, I spoke about the challenges for the industry leading into the pandemic and the resilience that was demonstrated. And I also spoke about how we at OSFI were working towards improving our transparency and our engagement. And I spoke about policy priorities in addressing climate, technology, and cyber risks. Next slide, please. Before I start speaking about the risks that we are focused on and what we intend to do about such risks, I want to take a few minutes first and speak about OSFI as an organization and the transformational change that we ourselves are undergoing. In December, Peter Rutledge, who began his term as Superintendent of Financial Institutions in June of 2021, just about a year ago, released our blueprint. And this blueprint is now available on our website. And the same blueprint that employees received, the public has received. And this summarizes our plans for transformation in the next 3 years, 2022 through 2025. And our plan is to expand our skills, to increase our agility, to rebalance our focus. And I expect many of these themes are similar to you and your institutions. We believe that this transformation is necessary at this time because the risk environment in which we operate has fundamentally shifted. The risks financial institutions are now facing are much more volatile, they're more complex, they're more interrelated and existential than they've ever been in the past. At OSFI, we recognize that unknown change is increasing. We certainly didn't start 2022 with the expectation of the protest in Ottawa or the extent of the war that we see in Ukraine. The risks we face today, including these increasingly unknown risks, are challenging our assumptions about the scope of sound prudential oversight and the capabilities required in order for OSFI to remain effective in carrying out our mandate. The blueprint has become our true north. That's the expression you hear Peter speak of, the true north, that provides our vision in which we transform OSFI to ensure that we thrive in intensifying uncertainty so that the public's confidence in a sound financial system remains unwavering. Next slide, please. There are 6 pillars of our transformation initiative: culture initiatives, risk strategy and governance, strategic stakeholder and partner engagement, policy innovation, a revised and modernized supervisory framework, and data management and analytics. Again, I expect that many of these priorities, culture, innovation, data, and analytics, are very familiar themes for each one of you and your respective institutions. Last month, OSFI announced major changes to our organizational structure to better align ourselves to deliver on the blueprint. The intent is that the new organizational design allows us to work more effectively with our financial sector partners in creating guidelines and supervisory expectations that are commensurate with the risks that often cross financial sector and public policy boundaries. One of the major changes in our structure was the appointment of Angie Radiskovic as Chief Strategy and Risk Officer, CSRO, who will be responsible for work related to strategic planning, enterprise risk management, risk surveillance, and quantification, as well as data and governance functions. Angie and her team are going to provide an independent oversight function, OSFI's own second line of defense, to ensure risk-taking limits are set and that effective challenge to the operation of the first line, that is my team and supervision, is provided. Another major change in structure was the integration of our supervision sectors. And I'm delighted that I'm now in a new role as of April 1, moving from Senior Director of the P&C Insurance Group to Executive Director of the Risk Assessment and Intervention Hub, where I have responsibilities for the supervision of all federally regulated insurers, banks, and private pensions. And now I'd like to move on to the risks we see ahead and what we intend to do about them. Next slide, please. In preparing my remarks for this year, I turned to two key OSFI documents. The first is the Annual Risk Outlook. We're calling it the ARO. We love acronyms for everything that OSFI will publish next week. As OSFI continually strives to provide more transparency to federally regulated entities, and that includes both financial institutions and private pension plans, as well as to Canadians in general, we will publish an annual outlook on the financial system risks that we view as most pressing and our intended responses to those risks for the upcoming fiscal year. We are providing this directional guidance with the understanding that the risks and responses will be revised if needed should the risk landscape change during the fiscal year, giving us the need to respond, the ability to respond to the unknown uncertainties if necessary. The second document I used in preparing these remarks is what we call the environmental scan. The purpose of the environmental scan is to provide a consolidated summary of considerations for lead supervisors of property and casualty insurers as they conduct their planning exercise for the next fiscal year. The environmental scan includes a current view of the Canadian economic environment and key risks that face P&C insurers. Note that the ARO, the Annual Risk Outlook, addresses risk in OSFI's plans for all federally regulated entities, whereas the environmental scan is very focused solely on P&C insurers. And now I'll move on to the discussion of the key risks OSFI is focused on, particularly for P&C insurers. And I'm going to speak today about climate, technology, and I have separate remarks for cyber risk, digitization, and cyber risk underwriting, about inflation, auto insurance, briefly about new products, human talent, and culture. And I can't speak to an audience such as this without a few comments about IFRS 17. So slide 6, please. Last year, I started my comments on climate, so let me continue with that tradition. And my husband always says that anything done twice is a tradition. So 2 successive trips with our sons to the Grey Cup became a tradition that spanned more than a decade of travels all across Canada to Grey Cup games. And I won't even begin to talk about traditions with Raptors and TFC and Blue Jays, but it was a great, exciting home opener last Friday. But I digress, so back on topic. It should be no surprise that OSFI's focus and efforts on building knowledge and resilience to climate risk continues to be front and center. Peter has spoken very publicly about the importance of climate. And just last week at the Financial Sector Forum 2022 with our federal partners, Peter spoke about how OSFI is growing its climate team from 2 people to 20 people this fiscal year. We are in the final stages of selection for 4 new directors in the areas of stakeholder engagement, data and analytics, scenario testing, and policy. As noted previously, OSFI is focused on transition risks, physical risks, and liability risks. Our work with the Bank of Canada on scenario analysis last year shows how a disorderly transition to a low carbon economy through delayed action and abrupt global policy changes will increase the probability of financial stress from transition risks. We recognize that decisions on the global path to reduction in greenhouse gas emitting energy sources is outside Canada's control and certainly outside OSFI's control. Nevertheless, federally regulated entities, financial institutions, and private pension plans must be prepared and build resilience to withstand an accelerated and abrupt pathway to the reduction of greenhouse gas emitting energy sources. With respect to planned supervisory and regulatory activities related to climate risk, it's our intent to supervise climate risk while we develop principle-based regulatory expectations. We expect that institutions are advancing their own climate-related governance and risk management capabilities and that they're increasingly resilient to physical and transition risks. OSFI and the Bank of Canada will conduct 2 more climate analysis exercises with financial institutions. The first will assess the financial impact of flood risk on the 2021 residential mortgage portfolios, and the second will leverage the findings from the 2021 pilot on climate transition risk to assess the impacts of repricing of securities portfolios and the probability of a price-mediated contagion to the financial system through a rebalancing of the financial institution balance sheets. At OSFI, we intend to leverage increasing capabilities in data analytics and risk quantification and scenario analysis of institutions, their capabilities, as well as our own internal capabilities in all these areas to help inform our microprudential and macroprudential assessments. Our supervision of institutions will help inform the development of principle-based regulatory expectations. And to further transparency, we've been public about our intent to issue guidance in the 2022-23 fiscal year that sets out our expectations of institutions' climate risk management and climate-related financial disclosures, which you may have also seen confirmed in the recent federal budget. To ensure that we're making the right prudential decisions, we are actively looking for opportunities to broaden stakeholder engagement within and outside of the financial industry, domestically and internationally. The expertise and the influence on the influence of climate can be found across industries and sectors, and the P&C insurance sector has much expertise and experience and tools that will help generate better outcomes for all. So now I'm going to move on, next slide, please, to speak about cyber risks. I'm going to stay on this slide for a while. Since joining OSFI in both internal and external discussions, next slide, please, Grant, I've sought to be very clear about differentiating technology and cyber-related risks that all financial institutions face, including P&C insurers, and the cyber risk that P&C insurers underwrite, the risk they assume either intentionally or unintentionally, and that would be silent or non-affirmative cyber. I want to speak about both of these topics today, and I will start with technology risks that all financial institutions are facing. And within the topic of technology risks, I again want to differentiate between risks associated with cyber attacks and risks associated with digitization and technology transformation initiatives, including emerging currencies and decentralized finance, as well as associated execution risk. So let's start with cyber attacks. It's our expectation that financial institutions are prepared for extreme but plausible cyber scenarios. A cyber incident, including a ransomware attack, has the potential to significantly impact critical functions at one or multiple institutions, especially if you consider a potential cyber attack at a dominant third-party service provider. As we are all aware, cyber attacks could consequently result in system unavailability, data loss, and/or the loss of public confidence, potentially leading to both the deterioration of an institution's reputation and financial loss. Given our mandate of contributing to public confidence in the Canadian financial system, cybersecurity is obviously a significant priority for us. The threats from cyber attacks to the financial system are increasing despite mitigating efforts, and the overall environment continues to become more risky. We saw this through the early months, now years of COVID, and we've seen it more recently through the early weeks, unfortunately now months, of the crisis in Ukraine. Threat actors continue to identify and exploit cyber vulnerabilities. Ransomware attacks continue to be reported by organizations, including financial institutions globally. Threat actors will continue to exploit software vulnerabilities in trusted software and third-party technology suppliers as an attack vector on their targets. The Canadian Centre for Cybersecurity stated in their National Cyber Threat Assessment that the financial information of Canadians is a target of cyber criminals and state-sponsored actors. And in addition, cyber actors are expected to continue to target Canadians' critical infrastructure, including financial services. We know that cybersecurity tops the list of concerns of financial institutions. You see it in countless thought leadership publications and risk surveys. In PACICC's benchmark survey report, cybersecurity was the #1 emerging risk in 2019 and 21 in both the short term, which they define as the next 1 to 3 years, and it increased in rank from number 4 to number 2 as the emerging risk over the longer term, which is defined as the next 3 to 10 years. The interconnectivity of the global financial system and the technology-based infrastructures has enhanced the need for more clarity about OSFI's expectations of institutions. The widely speculated disrupted cyber attacks that Russia may use in its conflict with Ukraine and what other targets they may have only enhanced the urgency of our work. In November of last year, we launched a consultation on technology and cyber risk management guideline. We will be issuing a final version of this in the upcoming months. We're looking at June, hopefully. The feedback we received was frank and helpful, and the resulting guideline will help to clarify our expectations and promote resilience to cyber and technological disruptions across the federally regulated financial sector. Other related regulatory plans include the issuance of another consultation this coming fall on a revised operational risk management guideline that puts more emphasis on operational resilience and reinforcing risk management. And we are spending considerable time focused on third-party risk. In a digital world, the financial services industry has long made use of third-party arrangements to execute and to deliver more of their critical activities. The emergence of a concentrated number of dominant service providers in key segments of the economy amplifies the risk of disruption of critical services and potentially market values, profitability, and reputations. In the next few months, OSFI will be consulting on a revised guideline on outsourcing of business activities. The revisions will reflect a more comprehensive set of risks in the broadening third-party ecosystem. The expectations outlined for managing third-party risks will be aligned with how critical and risky they may be to an institution, recognizing that not all institutions have the same risk exposures, and thus our expectations will be proportional. With respect to digital innovation, technology-driven disruptive forces continue to pose significant threats to financial institutions' business models and virtually all aspects of their activity and value chain. Digitalization, already rapidly altering the way financial services are delivered, has accelerated throughout the COVID pandemic. And with that acceleration comes execution risk that is tied to the human talent required to execute the change, as well as risk in the availability of the technology and tools to be implemented, on inflationary forces, supply chain interruptions, and the current war on talent. All of these are factors in influencing execution risk on technology-related initiatives. Institutions should ensure that digital innovation in products and services are not growing faster than the accompanying risk controls and risk procedures, particularly as related to third parties. Examples of digital innovations are the digitalization of money, including stablecoins, unbacked cryptocurrency, and decentralized finance, and consumer-directed finance, including on-demand insurance, all of which will most certainly have risks and impacts emanating from their use. While these may become critical to how companies interact with clients, the risk remains uncertain but potentially significant. We are working with various government partners and international organizations to assess the implications of digital money innovations on our regulatory frameworks. We plan to publish an advisory letter later this year that will clarify the capital and liquidity requirements to be applied to institutions' crypto asset exposures. We're also working with the Department of Finance on its development of a Canadian government-endorsed data mobility framework to address the rise of open banking and other consumer-directed finance arrangements. Sitting in my inbox from this morning is a just-issued report on the topic of open finance for my pleasure reading this long weekend. Part of our work includes considering ways to facilitate entry into the regulated federal financial system by non-traditional financial service providers. This work acknowledges that financial services are being provided outside of the regulatory framework, but institutions and consumers both still have high expectations for a safe and stable financial system. We have a duty at OSFI to contribute to confidence in Canada's financial system, and that includes considering how people and companies are choosing to interact with it. With all my comments thus far about digital innovation have been from a more broad OSFI-wide lens, banks and insurers, I do want to share a discussion from just last Friday that happened at our quarterly industry monitoring meeting of the P&C Insurance Group. We spoke about how we will all need to learn more about digital innovation from a currency perspective, likely in 3 areas. The use of cryptocurrencies or stablecoin by P&C insurers for claim payments or premiums in the future investments by P&C insurers in crypto or similar assets, and new P&C insurance products that may be designed for these currencies. And I've had 2 similar discussions on this topic with others just in this short week. I joked that we thought we had our work cut out for us with all our continued learning about IFRS 17 before implementation date and climate risk, but our inventory of to learn has just gotten significantly larger with the cryptocurrencies and the open banking. So what can you expect in terms of supervisory activities on all that I've just spoke about? In recent years, OSFI's for many years, OSFI's lead supervisors in the P&C Insurance Group have primarily conducted supervisory reviews of a single institution, going deep on many areas, on claims, on underwriting, actuarial, governance, going deep on each one of these areas. At times, specialists from our risk support sector or our actuarial division were brought in to assist with a specific aspect of an institution's review. It could be cultural, it could be actuarial. There's a trend globally and a trend you'll see at OSFI to conduct what can be referred to as thematic or horizontal or cross-sector reviews. This is where we focus on a single topic. We use a tool or a template developed by experts from our risk specialist teams, and we conduct reviews across a large number of institutions. And in planning for this current fiscal year that has just begun for us, we have plans for 3 such thematic reviews: in cyber risk, in digitization, and in third-party risks. We've identified institutions from our life insurance group, our mortgage insurance group, and our P&C insurance group for each of these 3 thematic reviews. We're using the early part of our fiscal year to prepare terms of reference for each review and finalize the tools that we intend to use. It's not our intent to go necessarily as deep across the multiple institutions as we would with risk specialists on a single review, but it is expected that we will gain significant insight and help us identify where further work is needed from a supervisory or potentially regulatory perspective. We hope to be able to communicate themes that we're seeing with those who are participating and potentially the industry. I want to now change my focus and speak about cyber risk underwriting. I spoke at length about this topic last year, and in some respects, it was PACICC's Risk Officers Forum when we first publicly stated our concern, although I had been speaking about it in various year-end supervisory meetings with individual institutions. But at the Risk Officers Forum, we came out public about silent cyber in particular. And I shared OSFI's plans for last fiscal year, which included a release of a letter from the Assistant Superintendent Insurance, and that happened last May, and our plans for an industry-wide survey on cyber underwriting risk, which happened last fall. And I want to thank everyone for your participation in the survey. Just as each of you are trying to become more automated and make the most of data and analytics, we too at OSFI, in developing that survey with lots of help from our actuarial division, did it with the idea of being able to aggregate the data in a very automatic way so that our analysis of the data could proceed with haste. And I was thrilled by the fact that we had a presentation on initial findings within only a couple of weeks of receipt of data. And the team, which has been led by Henri Boudreau, is in the final stages of analysis right now. Our intent is to have an industry-wide town hall virtual in June to share our findings across the industry. We also will share our intentions as to next steps, which could include further supervisory activities or potentially a regulatory response. I want to share that we fully recognize that cyber risk underwriting is an area where change is constant, like so many other areas and issues in which we're operating in today. Last week, I was in a meeting with Henri and Chris Townsend to discuss who we would be inviting to this June town hall, and we expect it to be a wide range as there's likely interest from those working in underwriting and pricing, reinsurance risk, etc. And at that meeting, Chris commented on how the data had likely already changed, in part potentially because of the Russian-Ukraine situation, from surveys that were completed in the late fall or January. But that doesn't negate the findings we will reach, but it keeps us on our toes for this ever-evolving risk. So that wraps up my comments on cyber and technology risk. That was a lot. I want to move on now to inflation. And the next slide, please, Grant. Canadian P&C insurers have long been facing significant inflation, both social inflation, which is also referred to as superimposed inflation, even before the situation with respect to economic or cost inflation became so significant. And I want to differentiate these two types of inflation. So by speaking of economic inflation, I refer to the changes in the price of the underlying goods and the services covered by insurance, which includes both wage and price inflation. And then social inflation, which refers to the extent to which claims escalate at a rate different from economic inflation, and that's influenced by judicial and legislative environments, as well as other social forces. Economic inflation is most notable historically in property and auto physical damage claims, where social inflation has been particularly impactful to liability claims. With the record-breaking economic inflation we are facing now, the impacts of that type of inflation is being felt across almost all lines of P&C insurance. And I think about how liability insurance will be reshaped in the future, and considering the growth in liability claims that we've seen in Canada. Increases in claims that have exceeded economic growth as social inflation for more than 20 years. And I know that personally from the decades of working and pricing liability lines of business in my prior role before supervision as an actuary. Year after year, where annual trends in claims for liability insurance were higher, at times significantly, than the annual change in CPI. When I was helping prepare the 2021 environmental scan last fall, I turned to a thought leadership publication of Swiss Re, and this was a Swiss Re Institute Sigma report that was titled More Risk, the Changing Nature of P&C Insurance Opportunities to 2040. So a very forward-looking thought leadership document. And I know that this was published in the spring, long before inflation rates have reached their current highs. But I want to share some of the thoughts that with you today that we put in the environmental scan for our lead supervisors. The Swiss Re report noted that COVID-19 litigation, social inflation, opioid inflation, sexual harassment claims, among many others, are shaping the near-term future of liability insurance. Climate change litigation, cyber risk, and the liability from emerging technologies such as AI, hydrofracking, and autonomous cars may further expand tort liability and liability claims in the period up to 2040. The potential for risk accumulation in the increasingly interconnected world also could further escalate claims. They note that the long-term growth in liability claims is influenced by economic factors, medical expense, wages, inflation, asset values, and also by societal and demographic trends, including longer lifespans, by developments within the legal system, and also the scope of liability insurance cover itself. Societal trends with respect to propensity to sue and of the value of fair compensation can impact both severity and frequency of claims that are filed every year. The scope of tort liability grows through legislation and evolution of case law, and many countries are experiencing an expansion of litigation, collective redress, and litigation funding. And all this leads to, for me personally, concerns, as I don't see any changes in any of these societal forces. And now we add to those the heightened economic inflation, and there is potential cause for concern. I worry that given the incredible profitable year that P&C insurers just experienced, I do think there are institutions that credit some degree of luck as well as all their hard work in ever improving underwriting, pricing, and claims activities. But I worry about how the combination of social inflation and economic inflation could collide and how insurers are going to ensure pricing adequacy, particularly in the regulated auto insurance environment in Canada. So what can you expect from OSFI on this issue? And I would not be surprised if you hear from the following type of questions from your lead supervisors. I certainly hope you hear these because these are the questions I wrote into the environmental scan. How concerned is the board and senior management with the hike in inflation? Have steps been taken so far, and if so, what? How are the current and anticipated inflation state reflected in pricing and reserving? Are there any anticipated changes to the investment portfolio or investment philosophy? What is the impact of the current economic situation on the claims department operations, on the effects of manufacturing disruption, increasing in pricing of construction supplies, delays for service providers such as auto repair shops, repair, restoration services? And from a people risk perspective, are there any effects arising from the scarcity of talent in the market in the current unemployment label? So I think the discussion of inflation and pricing adequacy is a natural lead into a discussion of auto insurance. So if we could go to the next slide, please. We all know the importance of auto insurance to the Canadian P&C insurance market. Historically, OSFI's lead supervisors have focused significant attention on auto insurance as laws and regulations were changed, often driven by political forces, and as trends in the cost of claims outpaced the changes in rates that insurers were able to achieve in the prior approval rate regulation environment of most provinces. While many insurers benefited significantly through the pandemic as auto results improved dramatically, driven by stay-at-home orders and changes in work-from-home patterns, even after relaxation of provincial restrictions, there are numerous headwinds for auto insurance. In the short term, there's concern about whether insurers will be able to sustain adequate rate levels, as I mentioned before, as driving behaviors return to the same level or even higher than pre-pandemic. Many are still avoiding public transit because of fears related to the pandemic, and thus in some areas, there are more cars on the road than before March 2020. Many insurers reduced rates or issued other forms of premium relief to reflect the reductions in driving during the early months of the pandemic. And there's unease for some insurers about how quickly provincial regulators will allow return to pre-pandemic rate levels. This concern is exacerbated by the effects of inflation, which show no signs of abating, and which are typically even higher for many auto coverages due to the advanced technology in today's automobiles, as well as the inflationary forces related to ongoing supply chain disruptions. Furthermore, there is uncertainty about how provincial regulators are going to weight the claims experience during the pandemic, now more than 2 years of claims experience, in the rate-making algorithms. In the long term, and that's just short term, in the long term, there's significant changes expected for auto insurance. For 2021, autonomous vehicles are identified as the fourth emerging risk over the next 3 to 10 years in PACICC's benchmark survey report. Autonomous vehicles were not in the 2019 list at all. The Sigma report by Swiss Re Institute includes 6 pages, the longest of any topic, directed at the future of motor insurance. They believe that auto insurance will see the biggest transformation of any line of business for P&C insurance. Increasing automation and connectivity of vehicles are expected to improve safety, thereby reducing accident frequency and severity of claims. But at the same time, the advancement of the importance of sustainability will reduce growth in auto premiums, particularly in advanced markets such as Canada, they predict. This expectation can be seen across downtown Toronto, actually, with the reduced number of parking spaces that are being built in some of the new condominium projects. I've seen numerous projections in thought leadership publications and at conferences about the notable growth expected in commercial auto premiums, due in large part to increases in the use of transport sharing models of mobility. While Swiss Re Institute projects that auto will continue to be the largest line of business for P&C insurers in 2040, they cite 3 implications for the future of auto insurance that I think are interesting to share. Auto insurance risk will become more complex. Auto insurers are going to need to understand the differential impacts of various types of technologies on claims, and also the differences in performances between brands, models, and generations of technology. They will need tools to effectively price and underwrite these evolving risks. The data that will be generated by cars is going to become increasingly important in risk selection and underwriting. Manufacturers have better access to the data generated by modern cars and are more knowledgeable about driving automation technology and its implications for accident frequency and severity. For insurers, Swiss Re notes this could be an opportunity to partner with manufacturers to offer user-based insurance products. And finally, digital technology will make auto more exposed to accumulation risk. The proliferation of advanced technologies in cars will subject manufacturers and their insurers to new risks, resulting in larger liability exposures and creating opportunities in other specialty lines. In particular, product liability and cyber risk will grow as cars promise additional safety features and are increasingly digitally connected. These comments are very similar to an August 2020 blog I read titled "Fascinating Ontario Auto Insurance Industry Trends." And in this blog, the author discusses, quote, the top 3 most interesting and latest insurance trends, which he says are ride sharing, car sharing, and UBI. In the description of UBI, the author writes, fully automated self-driving vehicles are no longer just an idea. They are something we could see on the road in the near future. Now, none of these are new messages, as these trends have been discussed at insurance conferences and in thought leadership papers for many years. However, we are fast approaching the future state with more advanced technologies and a greater number of cars on the road every day. While the industry is impacted by major changes arising from technological advancements and societal shifts in behavior, insurers are also affected by more routine changes that are implemented by provincial regulators of auto insurance. With respect to supervisory actions focused on auto insurance, you can expect your lead supervisors of insurers with significant automobile portfolios to seek information about the institution's eye to the present as well as to the future. You should hear them ask probing questions about your actions in response to recent regulatory changes of the auto product in Alberta and New Brunswick, as well as the ongoing changes in Ontario. But you should also expect that given the heightened sensitivity to diversity, equity, and inclusion, you can expect questions about attention on unconscious bias and racism, and if and how pricing or claims processes have changed. Finally, given the importance of auto insurance to the overall insurance market in Canada, lead supervisors will be striving to stay informed by proactively seeking out information about your strategies for the future, including but not limited to new products, pricing, underwriting plans, and partnerships and third-party providers servicing this line of business. I want to speak very briefly now to new products. It's on the bottom of the slide. And the risk of new products, and this appears as a topic near the end of our environmental scan. This risk is focused on concerns about new products where there's no historical loss information and where there are underwriting, pricing, and risk management challenges potentially. New products include identity theft protection, cyber, sharing economy, usage-based insurance, episodic insurance, and green insurance products responding to concerns about climate change. You can expect your lead supervisor to routinely inquire about new products as they seek to understand your approach to providing services, pricing, underwriting claims, risk management, reinsurance, etc. to such products. The next slide. The two final risks I want to speak about today are human talent and culture. With respect to human talent, the concern is that insurers will have difficulty attracting and retaining talent. And I note this concern is not unique to insurers right now. We see it across all types of financial institutions. In McKinsey's State of the Property and Casualty Insurance 2020 report, they noted that P&C insurers do not prioritize new talent acquisition, despite the fact that more than 1/4 of the industry's most experienced professionals are soon retiring in key geographies. The upcoming shortage of skilled and experienced professional has been identified in thought leadership and risk surveys for some time. PACICC ERM benchmark survey report cites human resources as a top risk for the short term and for the long term in both 2019 and 21. For the short term, this risk was 6th in 2019 and 3rd in 21, and for the long term, it was 7th in both years. I recall from my days in industry, and that wasn't that long ago, that this was listed as a key risk in our quarterly risk decks and spoken about at quarterly risk meetings. At that time, and it's about 4 years ago, well before COVID and the Great Retirement, we were concerned with the upcoming retirement as well as the letting go of senior staff, as many insurers went through transformation initiatives that looked at span of control and outsourcing, oftentimes out of country, and where many senior professionals were let go from insurance companies, and there was a loss of tremendous P&C insurance knowledge and expertise, and that they weren't being replaced by the same number of entrants to the industry. Given the importance of talent, you shouldn't be surprised by questions from your lead supervisors about what you're doing about recruitment and development programs. We know that return to work decisions have the potential to be particularly sensitive and could have ripple effects on employees' engagement and decisions to stay or leave. And thus, I would expect questions about these plans as well. Human talent is a good lead-in to a discussion of culture risk management. Last month, OSFI released a letter to all federally regulated entities on culture risk management. It's OSFI's intent to issue a principle-based, outcomes-focused culture risk management guideline later this year. That's our letter to the industry provided an opportunity to share our thinking and to seek your feedback. In particular, we are seeking comments on 6 proposed prudential outcomes that entities should achieve to support effective culture risk management. And the 6 outcomes are focused on leadership, compensation, incentives and people management, accountability and ownership, risk mindsets and behaviors, group dynamics and decision-making, and resilience. These outcomes would then form the basis of our future guidance and supervisory expectations. There are 5 specific questions for which OSFI is seeking your feedback, and I do strongly encourage you to respond by May 31st. Final slide, IFRS 17. It would be too conspicuous if I didn't address this in my prepared remarks. I generally feel that the P&C industry is in a good place. I believe that OSFI has been incredibly transparent and hope that you have participated in the recent town hall with Capital. Personally, I'm looking forward to the transition readiness test in the fall, and I'll admit that I was a big proponent of this exercise. And I want to be clear, I recognize regulatory burden. I read about it in the risk surveys. I felt it when I was on the other side of the table. As I said, I sat in your chair not too long ago. And there are many times I speak up and I question at OSFI the value of an ask that's being considered. Peter encourages an environment of fearless challenge. And as those of you who know me, I wouldn't be shy to speak up even if fearless challenge wasn't embraced. That said, I do believe that we are asking the right questions and for the right information about the right issues. This includes cyber risk underwriting survey, our new guidelines on many different non-financial risks, and the IFRS 17 transition readiness tests. I view this test as a chance to really see if you're ready to hit the go button. And as we sat around in numerous meetings at OSFI discussing the pros and cons of this test, I said I would have welcomed it if I were still in industry as an opportunity to see if I could go live and to have those few months to fix any remaining issues. We've been public that we don't intend to use the financial results for supervisory purposes or any other changes in the capital guideline. It's an opportunity for you to test if you're ready, and also for us to test if we are ready to read in your new data, to process it through our multitude of systems, and then get the data into the analytics that we rely on to conduct monitoring in a timely fashion. And with that, I will conclude my prepared remarks. For the topics that I've covered today and others that will be released in our annual risk outlook, such as climate, cyber technology, we are also including a timetable for our consultation and work. By tying risks to actions, we are committing ourselves to continued improvements that strengthen the prudential oversight framework, the resilience of federally regulated entities, and confidence in the Canadian financial system. This is part of our becoming a better partner to all of you at the forum. It sets us all up for success when engaging with those in the regulated sector and all those who rely on it. I'm happy to take any questions. I also want to note that I won't be shy if you ask a question I don't feel I have all the necessary details to respond to in the moment. I'll take note of your question and we'll make sure that I get the right people at OSFI to respond.
Fantastic presentation, Jackie. And so let's throw it open to the floor. Do you have questions or comments on what you've heard? Lots of information covered there. We have a few minutes before the hour. I see Alistair. So let's jump over to Alistair for a question.
Thanks, Ian, and thank you so much, Jackie. I guess the first thought as I listened to your comprehensive laundry list of things to worry about is that if you are a supervised entity, one of the things you can always wonder is, do your supervisors understand what you're going through and what you're working with and the issues you're contending with? And what you've demonstrated, I think, pretty compellingly is that OSFI's thought pretty hard about the same things we're all thinking about in the insurers where we work. So that's highly motivating. But it just, what was striking me was how much has changed even since last year. And so last year you had quite a section, if I recall, on the business interruption exposure and the lag before we'd really find out how big a deal that was, and some of the tracking you were doing on various sites just to get a sense of what was happening in the court systems of America, et cetera. And this year it hasn't come up. And we were all very focused on that issue last year. Has it really disappeared that fast, or is it still on your radar and just didn't fit on the slide deck?
Yeah, the latter. So we have a process, and Penny will know all about this, we do something called a QIM, a quarterly industry monitoring. So each of the lead supervisors goes through with their individual institutions and they look at financials and they have meetings and they look at key issues and they look at risk decks and board decks and audit committee decks. Then we all come together as a group. Now it's on the screen. There are 55 of us together on the screen. And we talk about what we're seeing and we talk about the trends and the key messages that we're hearing from our institutions. Preparing for that, we also do a scan of the literature. We are constantly looking. I just had Christy Ramatula update with the Supreme Court decision where they didn't hear a case and the implications. You probably all read about it in Thompson's, the Daily News, about the potential implications that would have on, COVID cases that were pending in courts. So we're constantly looking at it. But I was supposed to just have 35 or 40 minutes of prepared remarks. I apologize for running longer than that and limiting question times, but it's not that we're not looking at it. And we continue to look at that great site in the US with all the great, and they've just expanded their analytics and the depth of information that's on it. So we continue to look at it. We continue to talk to Australia, the APRA, the regulator there, and see what's happening in their court cases, and similarly in the UK. So it's definitely not been removed from our focus. I mean, one thing you said, and I know I just have 2 more minutes, I talked about a lot, and there is a lot. And we hear from institutions, be it CEOs or CROs, that, is this potential concern about regulatory burden? But I would challenge that and say everything I talked about is no different than what I talked about as an exec at the former insurer where I was before I came to OSFI. These are topics you should be talking about, and I'm confident you are. Technology risk, human talent, execution on your transformation, and other business as usual initiatives. Auto insurance, certainly, new products, the creativity. All of these are issues that you would be talking about in running a sound, institution seeking profitable growth and penetration in your markets. So I see us as aligned on the same path. And we really do want to be focused on principle-based, outcomes-based regulation, not rules-based. And everything that comes, through the OSFI, all the different internal peer review channels, that is always that's always spoken about. That is our goal, and Peter's been clear about that as well.
Jackie, I see in the chats, Randy had a question. Randy Bessie, you mentioned encouragement of an environment of fearless challenge in OSFI. What does that look like, and how has it affected your operations? Can we squeeze that one in?
So to me, it means, when we look at a draft of a guideline, and it doesn't matter whether it's Peter as superintendent or Bengali now as deputy superintendent, who I report to, that my voice and every other person in the room's voice, we all carry equal weight in the discussion as to, what should be the priorities, and, a healthy debate on, that seems a little too rules-based. Let's step that back. Let's make sure that we are this outcome-based, principle-based publication of our guidelines. And I welcome the feedback, even with the culture document that's outstanding now, and with the guideline drafts that'll come out in the fall and the rest of our fiscal year. When we seek feedback, please take the time to provide that feedback, and make sure that, we want to make sure it's meeting the needs.
And one other, and this is a really quick one, is the culture risk management guideline. Is that going to be effective immediately, or will it have an effective date?
So I don't want to promise anything, because and also I know this is going on for posterity on your website. I believe that what we've done with some of our other recent guidelines, including the reinsurance related ones, is there is a lag in effective date, recognizing that institutions need some time. So.
Fantastic. Okay, respecting people's clocks here, we're going to stop there. And thank you, Jackie, very much for very comprehensive presentation. And it's terrific to, the timing is ideal with all the transformation going on at OSFI and in the economy, and all the things in play right now is just perfect for you to check in and kind of clear the decks of all the issues. And I'm sure if people have issues, they will reach out to you if they have further questions, they're certainly always encouraged to reach out to you directly on that. And I will share your slides with all members in the industry so that everybody is brought up to speed on things.
Thank
So
you. And
thanks.
I do hope I'm invited back. While I do have a different mandate, P&C Insurance is always going to feel like home to me. I've worked for almost 40 years in this industry.
Excellent. I was kind of worried that you were going to rock it and look back on
Thank
it. But
you.
that's
Bye.
excellent to hear. And so thanks very much. So everyone, we're going to take a 2-minute break right now. I know in past surveys, everyone appreciates it's a 3-hour meeting. So just a 2-minute break between the hours. So let's do that now. Let's take and I've got a stopwatch here. We're going to start the clock, take 2 minutes, and we will be back with our next presentation on model risk. Okay, so be right back. Thank you. Okay, everyone, we are back. We are now going to turn over to our first discussion panel. And the next hour, we're going to look at model risk. So there is great member interest in model risk, the degree to which the industry is measuring the exposure to severe and tail risk events. And we thought it would be practical application to have representatives come in to talk about the work of the Florida Commission on Hurricane Loss Projection, methodology, and best practice information. And so we're very delighted to have Donna Sirmons, Manager Modeling Program for the Florida Hurricane Catastrophe Fund, and also Dr. Jack Nicholson, a consultant with Catastrophic Risk Consulting and former director of the Florida Catastrophic Storm Risk Management Center. And I'm going to turn the discussion over to you folks. Your microphone should be activated now, and you have the next hour. And certainly we invite people to participate in the discussion. Raise your hand if you have a question or a comment during their presentation. That's probably the best time to raise that rather than save things to the end. And they've been primed that it's going to be a conversation with our members out there. So welcome, and the floor is yours, and we'll pass it over to you. Thank you.
Thanks, Ian. Good afternoon, everyone. It is truly an honor to be with you this afternoon, and I am delighted to have Dr. Jack Nicholson be with me. Jack was a former commission member, and he served as chair of the commission when it was first established. And he had the challenge of leading the commission and developing the very first hurricane standards and establishing the model review process. Jack and I will both be talking through the presentation. I'm going to start out, and then Jack is going to have more comments to say at the end. And as Ian said, if you have any questions, just chime right in and interrupt us, and we welcome the back and forth discussion. So I'd like to start talking a little bit about the historical background that led to the establishment of the Florida Commission on Hurricane Loss Projection Methodology. The commission was created in the wake of disruptions and failures in the Florida property insurance market that was caused by Hurricane Andrew in 1992. At the time of Hurricane Andrew, most insurers were using a 30-year average of their actual claims losses to project future losses from hurricanes, whereas some of the reinsurers had begun using the sophisticated computer models for projecting their hurricane losses. And after Andrew, it became apparent that the catastrophe models did a much better job of projecting what the actual losses were. So the Florida legislature recognized the need to address these computer models, and also to address the problems that were happening in the property market here in Florida. So they created the Florida Hurricane Catastrophe Fund, the Florida Residential Property and Casualty Joint Underwriting Association, which is now known as Citizens Property Insurance Corporation, and the Florida Commission on Hurricane Loss Projection Methodology. The legislature recognized the need that they needed certain experts to be able to evaluate these models that were going to be used and to help resolve conflicts among actuarial professionals. And in order really to provide an immediate and then a sustaining ongoing improvement in the sophistication of the actuarial methods that would be used to be setting rates. And in the late 1990s, the Actuarial Standards Board began work on a standard to address the role catastrophe modeling of earthquakes and hurricanes play in casualty rate making. And so they, in creating their actuarial standard of practice number 38, they focused on the use of specialized models where the actuary has to rely on a model that has been created by other professionals rather than actuaries. Grant, if you would go to slide 3, please. Catastrophe modeling offers a more scientific approach, but it has been considered very controversial due to the proprietary nature of the models. And so the legislature needed to address some very key questions. One was, how are we going to handle this black box issue, and how to protect the proprietary processes and structure the intellectual property of the models under Florida's sunshine laws, and then what collective expertise would be needed to evaluate the catastrophe models. Slide 4, please. The legislature created the commission in 1995 as an independent body with the mission of creating the first hurricane standards by July 1996. And then in 2014, it expanded the commission to cover flood, with the deadline to adopt the first flood standards by July of 2017. The commission is housed within the State Board of Administration, and it is funded out of the Florida Hurricane Catastrophe Fund. And the commission operates under its governing statute. And the structure and processes designed by the commission are designed to address the black box issue. On-site audits of the models are conducted by a team of professionals, and I'll talk more about them in a few minutes. And in 2005, the legislature added trade secret exemptions from Florida's public records and public meetings laws, which allowed the commission to have full access to the models, and also to encourage the private companies to submit their models for review in Florida without concern of their trade secrets being disclosed.
Donna, let me interject a few comments at this point.
Sure.
I want to make the point, of course, Florida is actually an extreme case because we have a peak risk zone due to hurricanes. It's not possible to adequately diversify that across the globe. And as a result, we pay dearly for that risk, as well as other complicating issues that create uncertainty in for example, in our legal environment. And many times, if you take the perspective of Florida, it's more short-term related to crisis to handle particular problems that come up. And I think we do a fairly good job of dealing with that. We could certainly do better. And we certainly need to take a more broader view. And that's one thing that's very refreshing about this organization and some of the comments that we've heard so far, is that you are looking at the broader view and you're looking at some, long-term type solutions. And I think it's commendable that you talk to the commission, about how it operates. The commission is actually a very successful long-term program that Florida has created and adopted for many years now. And Donna just, went over slide 4, and I want to underscore the term independent commission. It is independent. It's not governed by the government. The government doesn't tell the commission what to do or approve it. Matter of fact, it's almost the other way around. The insurance regulator is governed by the results of the commission. And that's a process that has been developed over 27 years based on actions of the commission, and that have created credibility. And I think that's a key word, is credibility. And that's, if you talk to various people about the structure and the process commission, and in particular the modelers, I think they will all attest to the fact that it is a credible process that they have been allowed to participate in and so forth. So I just want to note that, because there's a lot of various models and organizations and countries and governments that use models, but I think that you're talking to the people here that have been involved with the most complex and thorough process of its nature. And there's a lot to be learned from this process over this period of time. So I'll turn it back to you, Donna.
Okay, thanks, Jack. Grant, if we could go to slide 5. The work of the commission is extremely technical and requires a lot of specialized expertise. And when the legislature created the commission, the statute requires that it consist of 12 members, and it specifically lists their qualifications, their expertise, and how they are appointed to serve on the commission. There are 3 actuaries: an industry actuary, an actuary from the Office of Insurance Regulation, who is responsible for property casualty rate filings, and then the actuary member of the Florida Hurricane Catastrophe Fund Advisory Council. Then the next 4 members serve on the commission by the positions that they hold within the Florida state government. There's the insurance consumer advocate, the director of the Division of Emergency Management, FHCF Chief Operating Officer, and the Executive Director of Citizens Property Insurance Corporation. And then the last 5 members, they are appointed, but they must be full-time faculty of the state university system and have specialized expertise. We have an insurance finance expert, a statistics expert, a computer system design expert, and I can't see the last little bit of slide. Let's see if I can move this up a little bit. Okay, a meteorology expert, and then a licensed professional structural engineer who must have expertise in wind mitigation techniques. Slide 6, please, Grant. The commission members give generously of their time to serve on the commission and to attend meetings, but they just really don't physically have the time necessary that would be required for them to go to all of the modeling organizations to review the models. So the on-site audits typically are four full days with 2 travel days on top of that. So in order to thoroughly review all aspects of the models and to exercise the commission's due diligence responsibilities, the commission has authorized a team of professionals to travel on site and evaluate the models for compliance with the standards. And the professional team consists of experts having professional credentials in each of the scientific disciplines that are represented in the models. There's actuarial science, statistics, meteorology, hydrology and hydraulics, computer information science, structural engineering, and coastal engineering. And each area is represented by 2 individuals. We have a primary member and a backup member. And the State Board of Administration contracts with these third-party vendors to provide the consulting services to the commission. And all this is funded out of the FHCF with an annual budget of around $1.65 million. And the professional team serves as the eyes and ears of the commission. We are very proud of the highly technical, highly qualified experts who are well respected in their fields that are working on behalf of the commission. And the professional team is involved in all phases of the commission's activities. They develop the report of activities, and this is a document that explains all of the processes, all of the standards, and lays out what is required by the modelers to submit their model for review to the commission. And the professional team does an in-depth of the submission documentation. We're also proud of the documentation that the commission requires the modelers to submit, because it really gives a wealth of information that is available to the public, so that people who use the models can really have a good bit of transparency into the models. And the professional team, of course, conducts the on-site audits. And during an audit, they have full access to all of the model, all of the computer code, all of the underlying science, the assumptions. And commission members are allowed to attend the on-site audits of the professional team, but they don't participate directly in the audit, and they're not allowed to participate in the deliberations of the professional team, because that would be violations of the sunshine laws. And the professional team, of course, they participate in all commission meetings, providing them with support. And they also keep the commission updated and educated on important trends and research in their fields. Slide 7. This is a snapshot of the experts that have been involved over the last 27 years. We've had 61 different experts serve on the commission and 30 different professional team experts. Slide 8. The grant, there we go. The role of the commission is clearly defined in the governing statute. We've had some outside parties come and want the commission to do some things on their behalf, but the commission always has to go back to its statute and look at the role that as it's laid out in the statute. Slide 9. And Florida law also spells out certain requirements that insurers must follow in their rate filings. And one is to use a model that's been found acceptable by the commission. Slide 10. I'm sure, as all of you know, the catastrophe models are very complex by their nature. And the commission's review is based on science. And within science, there is a lot of uncertainty, which comes out in the modeled results. There are at times a reasonable wide range of results among the models, but they are not unfairly discriminatory. And the modelers each use different scientific approaches. And although the models may use their own assumptions, all these scientific approaches and the assumptions that they make are thoroughly reviewed and they have to be justified. The commission reviews each model independently, and it looks at as I said, the principles and the assumptions that have been applied. The commission through the years has done a lot of work to better understand the variation and uncertainty in the loss costs. And as with science and technology, the catastrophe models are always evolving. Slide 11. The commission has adopted 21 overall guiding principles, and here's just an example of 4 of them. And the purpose of the principles is to keep the commission focused and not to stray from their mission. Slide 12. The standards that the commission adopts really guide the development of the models for each review cycle. And there are 6 categories of hurricane standards, and there are 7 categories for flood standards, with the only difference being the hydrological and hydraulic flood standards. Slide 13. The commission's review process is very rigorous and it's objective, and there are standards with subparts, disclosures, which are questions about the model, the underlying science, the assumptions that they've made that the modeler must answer in that public submission document. And then there are various forms that are generated to test and show the modeled results, of which the majority of the forms are publicly available. I like to say that the commission has moved the catastrophe models from a black box to a glass box, because so much transparency due to the commission's process is out there and publicly available. The audit requirements are proprietary items that the professional team reviews in depth during the on-site audit. And all of what I'm fixing to kind of say now is really laid out in detail in the report of activities, but I just wanted to give you a few examples for like the general standards. They deal with the scope of the model, identifying the expertise of the modelers, establishing the insured exposure database, and making sure that the model components are individually sound and operate independently, that no adjustments are made to improve the match of the historical observed to the modeled loss results, and that one component of the model is artificially adjusted to compensate for another. And the meteorological standards, of course, look at the parameters related to the wind field, the land use and land cover database, the overland weakening methodologies that are applied. And the vulnerability standards cover the development of the vulnerability functions for building, contents, and time element losses, as well as mitigation measures and building and local codes, how they are modeled in the model. And the actuarial standards ensure that the loss costs and PMLs insurers pay as a result of an event, that they are based on actuarially sound methodology, and they require that demand surge and law and ordinance coverage be included in the loss costs. And also they cover policy conditions and the process that the insurers use to analyze the claims data that they use to validate the losses of the model. And the statistical standards cover fitting distributions to historical data, and then the goodness of fit tests that are used to ensure that these distributions are reasonable. And they also require detailed sensitivity and uncertainty analyses that are performed in order to identify the most sensitive aspect in the model and to determine what are the major contributors to the uncertainty in the loss costs. And then the computer information standards address the model documentation, specifications of requirements, the software system and the business process designs, the model implementation and data, and verification testing of the components and the data that's used, the human-computer interaction and interface options, and making sure that there are formal procedures for continually maintaining and reviewing the code and the data and the documentation, and of course, security procedures. On slide 14.
Donna,
Yeah.
go ahead. I'll speak after slide 14. Go ahead.
Okay. So I wanted to say that, the flood standards follow the same framework as the hurricane standards. The general framework would be used for any peril, and you would just adopt standards that are unique to that particular peril. So just kind of highlighting some of the differences between the hurricane standards and the flood standards. In the general, we require in the flood horizontal location data, and also the use and conversion of horizontal and vertical projections. And then the flood meteorological standards focus on the coastal flooding parameters of storm surge, tide, and waves, and the propagation of coastal flooding waters inland. And then the hydrological and hydraulic flood standards focus on the inland flooding parameters, on precipitation, the land use and land cover there, and then the flood extent and elevation, or the depth of the flow, and also flood control measures, how those are modeled. And then in the vulnerability standards, the effects of damaging waves are required to be included in the vulnerability functions in the flood models.
Well, Don, let me just interject with that. I saw a question pop up that asked, are there any other states or jurisdictions that have a similar operation to the commission? And I think I can say categorically, no. I don't know of any country in the world, any review process that is as thorough as our process. It may involve, say, like, I'm sure that rating agencies, AM Best, Moody's, Fitch, and all that have their review processes, and they do. Individual companies will go on site and review models and actually bring in their actuaries and do it under a confidential basis and so forth. But as far as a open commission, as far as a independent commission, and one that's separate and apart from a government agency and so forth, I know of no other state or country that has something like this. And I wanted to comment with regard to earthquake, just flashing back to 2014 when the state of Florida was required to develop flood standards and review flood models. Donna and I think she will attest that we spent weeks and months agonizing over how to do all of that. And I think we found two things. One, there were similarities, and Donna went over a number of similarities on how the standards would work. And there's no reason that those similarities couldn't work with earthquake or any other type of modeling, whether it be cyber risk or you name it. Where the differences lie is where the specific peril is involved. We had to understand specifically what flood was versus wind. That's not so hard to understand just as a layman, but when you try to think about how these things work, and how they're different, meteorology has to do more with the wind, and there's some, storm surge with hurricanes, but generally that's excluded in insurance contracts. But then when it comes to flood, well, the wind is not covered, it's the water. And how can we have, you can have storm surge, you can have inland flooding with river flooding, or you can have non-riverine flooding, where you have flooding over land that's normally dry, but it maybe runoff water and things like that, urban flooding due to concrete. So anyway, those are the things you have to think about in evaluating, different types of models. I just want to make those comments. Donna, so I'll throw it back to you.
Okay. Grant, if we could move on to slide 15. So a very key point is that the models must pass all standards, and only one version of the model is permitted. The model can be in different software platforms or software packages and on different platforms, but it has to be the same model. And the hurricane and flood models are reviewed independently. If a modeler has a hurricane model that has been found acceptable, and then they submit their flood model, and there for some reason the flood model was not determined acceptable, that has no impact on the acceptability of the hurricane model, or vice versa. And only long-term models have been found acceptable thus far. There has been no formal voting on any other model types. RMS did submit their near-term model with a medium 5-year time frame under the 2006 standards, but they withdrew that model prior to the commission reviewing it for acceptability, and instead they reverted back to their long-term event set. On slide 16. There are currently 7 models, hurricane models, that have been determined acceptable by the commission under their 2019 hurricane standards. Bear Risk, which was previously AIR Worldwide, was the first hurricane model to submit and be found acceptable under the commission's first set of standards in 1996. And then in 2006, the state passed a law to develop a public hurricane loss model, which is housed at Florida International University. And our 2 newest models are Karen Clark and Company and Impact Forecasting. Also, Karen Clark and Company is the only modeler who has submitted a flood model under the 2017 flood standards, and that model was found acceptable. And then we are expecting to receive 6 flood model submissions under the 2021 flood standards, and those are due on November 1st of 2023. Slide 17. There have been other models that have been involved in the process through the years, but they are no longer involved. And slide 18. Here's just a couple of quotes that I picked out because the modelers do support and recognize the importance of the work of the commission. On slide 19. And Jack talked about this, that there's no other process that we know of like there is in the state of Florida. And as a matter of fact, some regulators that we know of that have contacted us and talked with us, one of the first things they consider when they're reviewing a rate filing, the use of the model, has it been found acceptable by the commission. On slide 20. Value is found in the process itself, and the entire process is very important and adds credibility. And we have laid out in slides 20 through 30 an overview of the details of each step of the process. But for the sake of time, Grant, would you mind advancing on to slide 31? And I'm going to turn it over to Jack for him to make some comments. And then if we want to be sure we get to your questions, and then if time allows, we can go back and walk through these slides here, because the process is very detailed, but great. So I'll turn it back over to you, Jack.
Okay, thank you, Donna. Wanted to talk about various catastrophic modeling issues. Risk assessment and underwriting is, oh, wait a minute, do we have the right? I think we had a different, I think we eliminated a couple of these, Don, because these were not, this is not the same list. But anyway.
Right. I shortened it for you.
That's okay. Anyway, I'm going to start off with the rate making, because rate making is generally the big issue when it comes to what people have to pay for their insurance, and that's where the concern comes in about doing it accurately and appropriately. And there's where models in 1995, the legislature passed the law that created the commission, and that was the main emphasis. It later added probable maximum loss analysis, PML analysis, and all of you are familiar with that terminology, and you would look at earthquake modeling the same way. What is your 1 in 100, 1 in 500, maybe 1 in 1,000 PML? You want to know that information to the extent that it can be modeled. And my understanding with regard to earthquake modeling, you're going to consider various earth faults, the distance that some property is located to those earth faults, the type of land structure or soil structure that the exposure is on, and many other factors come into play there. But the whole idea of probable maximum loss assessment and analysis is that you want to determine the financial strength of a company. Is it going to be able to handle this amount of loss or not? And I'll go so further to say something that you're doing is how will a system handle a loss? And I think you're concerned about the viability of your system, and I think that's something that Florida needs to be a little more concerned about too, because we're well aware of stress testing individual insurers, but I'm not aware of any effort that has been made to stress test a system, except for one, and that was one that I did get published with Karen Clark in the Journal of Insurance Regulation. So that's a little advertisement there for you. But anyway, we did look at the stress testing the system to see how things would work. But that's something that needs to be done on an ongoing basis to determine the vulnerabilities, just as, and that seems to be a big interest of yours, is what is the vulnerability of your system? Can you finance it? How can you finance it? What are your alternatives? Are the various earthquake models accurate and reliable to use? Are there any concerns or deficiencies you need to be concerned about in that process? I'll say something that Donna mentioned, that I was the chair of the Florida Commission for the first couple of years it was created, and anyway, I remember making the comment, and I didn't. This is not my quote. I can't even find who said it, but we've all heard that the bad thing about models is garbage in, garbage out. And then there was something I found that somebody else said that was talking about even something worse, and that is garbage in, gospel out. So I think you have to very carefully look at the models and make sure that you're not putting garbage in them, and secondly, make sure you're not totally believing them that they're gospel, because they're not. And there are other considerations and insights that you need to have when you're dealing with any type of modeling or statistical procedures or simulation procedures and so forth. Now, I mentioned earlier that rating agencies are very concerned about modeling, and they do have their own internal review processes, and insurance companies do as well as other state regulators. I don't know that certainly other state regulators, there could be some that do a very thorough job, but I'm not aware of what they do and how thorough they are. But I would venture to guess they're not as near as thorough and as complex oriented as we are in trying to understand the nature of the models and whether they're appropriate or not. The models are also can be used for marketing and underwriting purposes. And we see a lot of times in Florida where a insurance company will go to a reinsurance broker and provide its exposure data to the broker, and the broker will use several models to run their exposure and then come back with an analysis. And sometimes it's a kind of a real-time thing where you can change the parameters to say, well, what if we wanted to reduce our PML from 200 million to 150 million, or $1 billion to 700 million? What would we need to do? What would be the best way to do that? And then they could use the models to show where you could get rid of certain ongoing risk and therefore have a different book of business. Sometimes they'll use models to find out where they have underpriced risk. And this is a real big issue with me, and it seems to be I'm the only one that's concerned about it for the most part, but I brought it up several times and nobody wants to talk about it, whether it be regulators or actuaries. But like in Florida, if you have a rate filing, 9 out of 10 times the actuaries are kind of flattening rates. For example, since the rates are pretty high in South Florida, they'll lower those a little bit, and then or maybe lower them a lot and then increase them a little bit for the other parts of the state. And I often say that, my first day on the job when I was hired as the bureau chief of rates for the insurance department in Florida as a regulator, had a meeting with the commissioner, and we had a rate filing that required exactly that: reduced rates 25% in Monroe County, which is in the south part of the state, Dade, Broward, and Monroe, the three southern counties there, and increased the rate. So they were reduced by 20 to, they showed an increase of like 35-40%, but they capped them at around 25. And then the rest of the state, instead of it being maybe 5%, they raised it to 9%. So that was a way to level rates. Now, you can do that with models. You can find out where you've had to do that. And then what are you going to do? If you're an insurance company in Florida, you're going to find out that in the south part of the state, you've raised the rates. So therefore, where do I get rid of exposure to reduce my overall PML? South Florida. But in doing so, we have a residual market, citizens property insurance, and that may also cause those people not to have a market anymore because their company basically went up on their rates or canceled them. They didn't go up on their rates, they just canceled them. And then Citizens has to take on that business at a much higher rate. So anyway, that idea of rate flattening, I know it's used all the time by actuaries, and you can say, well, it's actuarially sound, blah, blah, blah. It's nature of insurance. I get it, but it also can have some adverse consequences that you need to look at, more of a long-term nature of how things are being done. I might talk about some other topics. I know that Donna mentioned the Karen Clark and Company model. Karen Clark actually had the first model, hurricane model that was approved in Florida. It was the AIR model that she later sold and no longer has a relationship with Applied Insurance Research, or now it's called AIR. But she was the first model to be approved, and now coming back several years later, she was the first. She has a different company, Karen Clark and Company, that has the first flood model to be approved in Florida. So she's pretty aggressive at sticking her neck out, so to speak, and doing things like that. But one of the things I wanted to mention is her model. I've authored a paper with her, and then we've also, when I was at Florida State University at the Storm Center, we used her model to model the insurance system, kind of like what you may be talking about with how you look at earthquake. But we did it that way to determine where there would be certain mismatches of risk with Citizens and the the industry. Now, this is kind of a hypothetical problem. If you have a similar exposure to Citizen, there's no reason that you can gain by lowering. You can't lower your exposure or PML by doing a whole lot different if you've got a pretty good distribution of risk. But if you didn't, there may even be, even though Citizens may write higher priced risk, you may be able to lower your PML by diversifying and taking some of Citizens' risk out. They're of course, the residual market in Florida, and if you took a certain type of risk out and combined it, the overall correlation would be such that you could actually lower your PML. So Karen Clark's model we use for that. But another thing that it does, it's kind of unique to her model, is it does something called characteristic event analysis. And actually that was somewhat stolen from earthquake modeling, is my understanding. And I'm not sure exactly how that works in earthquake modeling, but with hurricane modeling, it was basically a way to look at events that could have, 100-year events and 50 and 20-year events that could have occurred around the state, and then looking at a company's exposure in those areas to determine whether they were over or underexposed. And when you look at it that way, you may find that a company has a AAA rating with AM Best, or with Demotech is another rating agency that people use in Florida, and they may think that, well, this company's in good shape, but yet they may actually be at risk because they haven't taken into the models only use one number, and that's the PML, one number PML, versus having various numbers for just about every county and different locations, which the Karen Clark and Company model has, that evaluates those characteristic events. So there are ways that even the PML analysis can be improved upon with certain science, and maybe eventually the other modelers will go to something like that. And I'm not suggesting that they do the same thing. They all have their unique approach to how they deal with risk. And then the last thing I want to mention is just climate risk. And I know I really haven't said a whole lot about this and anything or written a whole lot about it. I did write something on the future of insurance, and one of the issues which came out of a conference that we held at Florida State University in 2018, and it dealt with the future of insurance, but one of the topics was climate change and how that impacted insurance companies and claims and so forth. And one of the comments I made in that is that the climate models are somewhat controversial, and that there ought to be a more thorough way of evaluating the models. And maybe the National Association of Insurance Commissioners could take a role in looking at that. So I don't think that's gone anywhere, by the way, so you can wish me luck on that. But anyway, I just felt like that we do have a procedure. And Donna, kind of skipped the details of the procedure just because of limited time. But we do have a very thorough process that leads to good results and incredible results, I believe. So I think that's always necessary, and like I said, it's very valuable to have an independent experts and non-government type related processes, so that you don't get any political bias or things like that involved that can complicate and cloudy the issue. So anyway, that concludes my remarks, and I guess, Don, I'll turn it back to you, but we're certainly amenable to questions and whatever you want to do at this point.
Right, Ian, if you want to jump back on and if there are any questions, but while you're doing that, I just was thinking about, Jack talking about the process, that the commission's goal is to have these models to be found acceptable. So it has developed its process to where if there are problems, it gives opportunity that the professional team is really crucial to the process. And when they've conducted an on-site audit, they've discovered errors in the code, or just a problem in human error, and that like we need to automate these scripts and processes to eliminate these issues. So the commission has in its process, it allows for opportunity for the modeler to make corrections and to submit that corrected model and to be reviewed. And so the commission has really worked with the modeling industry to develop a really a stable process that allows, tools to be out there to be used.
Excellent. Okay, who out there has questions for Donna and Jack? Mr. Allister, let's throw it over to you, please.
Thanks, Ian, and Donna and Jack, thank you so much for the time you've given to us today. The reason that I was so excited about this topic and your presentation was that in Canada, we spend a lot of time reassuring ourselves that we're adequately capitalized and properly reinsured for awful worst case type scenarios. And so a lot of that relies on models. That's true for quake, but as an industry in Canada, we are now trying to work out how to better model and understand the risks associated with flood. And we are just early in the stages of trying to work out whether there's enough science to model wildfire. And those types of events, maybe newer to have such big impact in Canada, are very unsettling. And up until now, our regulators have been, I think the term is model agnostic. So they have simply asked that underwriters demonstrate that they've used models and that they have adequate capital and reinsurance based on those models. And so that all really comes down to the idea that there is a model risk, which is the science could be wrong, or we're just not smart enough as humans to properly calculate everything that the Earth can throw at us. So I guess, given all of the hard work you've done, maybe this is not fair, but it's I just was reading about the failure of another Florida insurer in the last few months, St. John's, the number 8 company, and it's not the only one. So assuming that they were using validated models of yours, where is the gap in the prudential system in Florida that is continuing to see failures happen even when they're using an approved model?
I'll answer that question, Donna.
Thank you, Jack.
One of my favorite questions, matter of fact, I like it. In the past 12 months, I think we've had 4 insolvencies, and which is it's kind of strange because we haven't had hurricanes in a couple of years. Although with Michael and what was the other one?
Well, there was Irma, and
Irma
then
and
Nancy
Michael.
as
I'm
well.
sorry. Irma and Michael were bad, and they did carry with them something that is not really considered thoroughly in the models. I mean, the models consider the past history of data. Okay, and if that past history works into the loss results, then it gets into the models eventually. But the problem is something called loss creep or adverse loss development. And what that was being driven by was, I guess a broader term would be social inflation, but another term would be, legal inflation, where you had a lot of involvement by trial lawyers and public adjusters. We have a tremendous number of public adjusters compared to any other state. Trial lawyers, I mean, there's some statistics that I won't quote right now, but pretty high statistics in terms of how many claims that Florida has versus how many get litigated. So we have a very high percentage, something like 75%, that's way beyond the national average. Or I think it's about 75% of all litigation in the country is in Florida. But at any rate, those things are not part of the model. We've often asked that question: do you model for this, that, and the other? And it's more of a actuarial concern. When you do your rates, you can add certain things. If you felt like that there were certain non-modeling components to the rate filing that ought to be in there that aren't considered. This is where I said, the worst thing is gospel, garbage in and gospel out, but at any rate, you have to question how that works in a rate filing, and then you have to make sure that your rates are solved. You're going to create a solvent company through that process. And maybe I'll answer more of that question, but I wanted to clarify something because somebody popped up with a comment I had made on rate flattening, and I might have said that it was actuarial okay or something like that, and I'm not sure whether it is or not, so I'm not an actuary. And I guess my comment really was related to when you create territories, you're always going to have, different rates because you're doing territories. And sometimes, right there at the border, a guy across the street has a higher rate than you, and you have the same type of house and stuff like that. So there is some stuff that happens like that. And I was, trying to exaggerate a problem. And that's why I was mentioning what models can do and can't do. And then let me go on to another question I saw pop up, and that was with regard to, do we compare models? And Donna could probably answer that better than me, but I'll just give you a historical answer. And I always push for this: no, no, and no. The idea is to review individual models under standards that we create, not to compare models. I mean, if you did that, who do you think well, you may have a regulatory actuary that says, well, let's just use the model that has the lowest rates. And we've had people say that with the Florida Hurricane Catastrophe Fund, by the way, which uses all the approved models to determine rates, five of the 7, put it that way, Donna's saying. And there's a procedure for doing that. But we have never felt that it was appropriate, although we have compared models for the legislature and kind of showed how some of them work. And we had a really good analysis that did that. But it was not part of the commission's work. It was really a response to, I think it was Representative Rubio at the time, if I recall.
That's right. I'll add to that, Jack, on that comparison, because the legislature was interested, because you had model results that were varying at 1,000%. And so they could say, how can one model be right and another one be wrong? And so the Speaker of the House commissioned assigned the commission to study the comparison of the models. And so what we did was we took 972 different models that are available out there in the public domain. And we set a benchmark,
let me just say that some of those were hypothetical models that our professional team were able to create due to their brilliance, by the way.
That's true. And so I wish I had the slide. I could pull it up. Maybe I can send it to Ian and that you could post it or something. But what we did was we took all of the models results by county and threw it within that range of the min and the max and saw where they fell within that baseline. And if anything was an outlier, of course, we probed into it. But basically, all of the models fell within that range of acceptable results. And there were just a few outliers, which we, studied and got the details on to understand better.
There was another question, folks in the chat, about litigation funding and causing loss creep. Maybe you could talk to that as well, please.
Yeah, I think this is where, Florida is really down in the weeds in terms of insurance, is that we have a claim and we have a hurricane, and then we have people that go out into the neighborhoods, sometimes working for lawyers in the past and contractors and all that, and they will find a policyholder and say, look, we can fix your roof for free. The insurance company will pay for it, blah, blah, blah. They'll do that. And then they'll go to the next neighbor and the next neighbor and the next neighbor by spotting a little bit of one shingle's a little bit damaged. There's a rule that says if part of your roof is damaged, you can replace the whole thing. One time I was thinking it was like 25%. If it's more than 25%, you just replace the whole thing. And sometimes there's like these almost like pair and set clause. You know, if your roof you can't get the material to match it, you got to just replace the whole thing. So there's that type of problem. And then there's things that aren't hurricane related, because it's these problems that we're having are not necessarily hurricane related. A lot of it is water damage, where a policyholder, like let's just say me, you know, let's say last night I flushed the downstairs toilet and it just kept running and overflowed and it kept running. And next thing I wake up in the morning, the whole kitchen and the den is all soaked. And although I don't have carpet down there, let's say I did. And, you know, so I find that out at 3:30 in the morning, and I call a plumber by 4, and he says he can get out there by 5:30 and stop it and start working on it. And then he, in the past, has brought me an agreement to sign, and I signed the agreement. And basically, the agreement is assignment of benefits to him under the contract. And I don't know, but he's in cahoots with a lawyer that takes all of my rights against the insurance company. And then what they do is they file a claim, file a suit before they even file the claim, practically, you know, maybe concurrently or something. Insurance company hasn't had an opportunity to settle the claim, even know about it. Next thing you know, they're being sued. And in Florida, it used to be, we did pass a law a couple of years ago, but if the insurance company settled for $1 more than was demanded, then, you know, or more than the amount of the law, I forgot exactly how the wording was, but basically you were stuck with the lawyer's demands at that particular time, which would include the attorney costs, what the insurance company has to pay, all the attorney costs plus the claim, and in some cases fee multipliers. This is something that originated in the liability field, but it expanded to property and auto and everything in Florida. So we have all of these issues piled on top of things, and it's creates a lot of uncertainty and high premiums in Florida.
That is great. I think that is going to conclude our hour here. That's probably a good place to stop. I'm going to share your slides, and there's contact information I see on the last slide that people can reach out to you with further questions. And you've done a great deal in terms of pulling back the curtain on model risk. And I'm sure you're going to hear from our members directly in future. So thank you very much for being part of this. And we're going to take a break now for 2 minutes and switch over to our next discussion panel. And if everybody could be back in 2 minutes, we will rejoin the broadcast. And thanks again, Donna and Jack.
Thank you.
Take care. Okay, we are back. I'm going to ask our panelists to join us now, Katherine and Tracy. And our first session, our first discussion panel looked at externalities, flood and hurricane with model risks. And now we're looking at preparedness for when something goes wrong. And you will notice we only have 2 panelists and not 3. They are quite resilient, these two. We had Michael Arrett from PwC had to drop off the panel. Unfortunately, other issues came up, and so we are down to 2. And this is an issue that our Risk Management Advisory Committee expressed interest in when we were planning our sessions for the year. And Tracy has opted to join the panel to help lead the discussion here. And so we have 2 people, Katherine Macpherson, Associate Partner, Financial Services Risks with Ernst & Young Canada, and Tracy Mann, Vice President, Enterprise Risk Management, Chief Compliance Officer with Definity Financial Corporation. And also, I should note, Katherine is National Operational Risk and Resilience Leader. So they're going to lead a discussion on operational risk and operational resilience. And we invite your questions and comments throughout. And I will throw it over to you 2 now. Welcome, and the floor is yours.
Thanks, Ian. I'm going to actually share my screen. I think I'm able to just do that directly here. So give me 1 second. And I'm going to go. Can everyone see? Are you? All right.
Yes, perfect. Thank you.
All right, awesome. I'm going to just put it in slideshow mode here. Okay, so yes, Tracy and it was all part of the plan, right, Ian, where we wanted to demonstrate our resilience and being able to respond to unexpected changes. What we've done is we've pulled together kind of a brief presentation rather than like a panel discussion on what we're seeing in the market in terms of responding to the increased regulatory expectations and requirements around operational resilience, and also what it means for the P&C industry, because every industry will have be impacted very differently by the new expectations. So I don't want to spend, I'd originally planned this, let's walk through a summary of the regulatory environment, but you guys had actually OSFI, the leaders here today on the call. So I'm not going to spend any time kind of summarizing the key priorities that Jackie very aptly communicated to everyone on the call today. That said, from a global perspective, we do see other jurisdictions who have already issued their, let's call it their guidance notes and their guidance papers and published their expectations, with the UK leading the pack. So many organizations that have UK operations have had to already demonstrate compliance with the UK's, the PRA's regulatory requirements on operational resilience. The deadline was actually March 31st. And so what we've done is pulled together some insights that are from our supporting clients, both in the UK, US, and also here in Canada, to establish their operational resilience programs. So first, before we get into the actual tactical aspects of it, I like to start the presentation by focusing on like what's the value proposition from an operational resilience perspective. Why are regulators, why are boards of directors, why are CROs and senior risk leaders kind of mobilizing around operational resilience as a new discipline, a new risk discipline? So I'd like to talk about it in the context of the knowns and the unknowns. And this is something that we used when I was working in the insurance industry primarily to help the actuaries. I'm sorry, I'm not an actuary, but when operational risk first came out as requirements and OSFI was asking the insurance companies to also adopt operational risk management practices, we found this very useful to talk about how operational risk is more of an art than it is a science. And so if we were to plot the various operational risks in any organization across a two-dimensional scale, where we're measuring the degree of acknowledgement within an organization that the risk actually exists, that there is a risk, and against the knowledge of the risk. So in other words, how much information do we have about the risk to actually be able to do something about it? There would be 4 types. We could basically categorize all of the different operational risk types into one of the following 4 risk categories. So on the top right-hand corner, we would have the known knowns. So this is where there's a very, very high degree of acknowledgement that the risk exists and that the risk is relevant to our organization, coupled with a very high degree of knowledge and understanding of what the risk is, how it might threaten us, how it might impact us, and therefore these types of risks typically have very mature risk management programs around them. There are automated controls, system-based controls typically that are in place because we have so much information on how the risk might affect us that we're able to put in place those types of strong internal control environments. On the flip side, if we start to look at more of the unknowns, the known unknowns, I would say, are where there's a very high degree of acknowledgement that there is a risk, but we don't necessarily have enough information, or there's not enough information available for us to really put in place strong controls, for us to know exactly what to do. And this is, I'd say, like it's a parallel or similar to emerging risks. Right? These are things where it might be happening outside of our sector, outside of our industry, outside of our jurisdiction. It hasn't yet impacted us or manifested in our organization, but we know it's out there. We know it's on the horizon. And so what these targets that I've put on here represent is, from an operational risk perspective, where do you want to mobilize your resources and your funding? How much value is there? It's the relative amount of value that you stand to gain by investing in your operational risk management capabilities to increase either your knowledge of the risk or your acknowledgement within the risk. So emerging risks, there's a lot of value because you're focusing on things that haven't yet happened, and you're enabling your organization to be more prepared and to have a certain level of readiness for if and when it does happen. down on the bottom here, we have our unknown knowns. This is where there is a very high degree of knowledge. So someone or some people or functions within an organization, they are aware, they see risk happening, they see incidents, they see events happening, they see the exposure, but there's a very low degree of acknowledgement for something to be able to be done about it. This is very, very prevalent when it comes to conduct risks, right? Where it could be indicative of where people are actively trying to conceal problems within an organization. Or on the flip side, which is also just as damaging, it could also represent if you have a complacent culture within your organization where people see stuff, but they're not raising it to the level of the organization for decision makers to actually take action. Either way, there's a lot of value from an operational risk perspective to focus on building capabilities to increase the degree of acknowledgement and to unearth where some of those potential nefarious or it could be accidental, type behaviors are preventing risk from rising up and being visible at the right levels of the organization for actions to be taken. Lastly, we have the unknown unknowns. And this is where, when we're talking about operational resilience, we're not trying to predict where you don't want to spend a lot of time and energy trying to predict where those unknown unknowns might be. There's not a person in this room, a virtual room, that I think that would have had a pandemic preparedness plan, for example, that assumed global impact, 100% employee impact. I don't think that anyone, although everyone might have had a pandemic response strategy in place, likely the assumptions were not aligned to the type of a pandemic that we're actually living through right now. And so this is where you don't really have a lot of knowledge on the risk. You don't really have a degree of acknowledgement of the risk. It's something that's so far out in the horizon that is so unprecedented that putting resources in place to predict would just be not very cost benefit efficiency. And so what you want to do here, though, you want to acknowledge that you don't know, essentially, and you want to be able to put in place certain controls and mechanisms so that if and when something does happen that is completely unexpected, that was completely unheard of, it's the first time, you have the sufficient controls, people, culture, to be able to respond quickly and respond effectively to mitigate the impact of whatever that event is. And so when we're talking about operational risk and operational resilience, which we will do today, I just want to kind of set the context for the different lenses that we should be applying to the value of why do we do this? Why are we putting in place operational risk management frameworks? And why are we going to be focusing on building out our operational resilience capabilities? And what do we stand to gain? Okay. So, we also like to clarify between operational resilience as an outcome. So I would call that kind of a small o, small r resilience, and operational resilience as a new risk framework, which is really what's happening on a global scale where the regulatory agendas have it at the top of the list. And so it's resulting in net new frameworks, net new capabilities being established within the organization. So operational resilience has obviously always been on the agenda. It's always been the goal of operational risk management specifically. This isn't changing, but one of the goals of operational risk management is to drive integration across all the different operational risk types. You have third-party risk, you have business disruption risk, you have conduct risks, technology risks, cyber risks, third-party, I think I said, there's so many. Operational risk is so wide and affects so many, every business in the organization is generating operational risk and is being impacted by operational risk. And so recognizing the breadth and depth of operational risk and what it represents to organizations, regulators they're asking for more explicit ability of organizations to be able to demonstrate, how do you get assurance as risk leaders? How do you provide assurance to the board of directors that your organization is in fact ready? And that you are demonstrating the level of resilience that's required to stay within your risk appetite, which is part of the status quo, and to stay within what the new concept of what's called an impact tolerance. And I'll speak a bit to that in a moment. So in terms of what's really changing, Organizations are now going to be expected to have kind of an enterprise-wide approach to operational resilience. So that's very much connected to operational risk management frameworks that are already in place. But it's how do we pull the outcomes? How do we use the data and information that's being generated by all of the operational risk management programs that are already in effect within our organizations, and use that information to provide a more explicit and demonstrable position or posture from an operational resilience perspective. Part of their ability to do that is, and one of the new expectations is that service dependency mapping is coming to the forefront. OSFI in Canada as part of their existing E21 guidelines, has spoken about the value of business process mapping as a operational risk tool. Regulators in Europe and UK and US, where they have guidance issued, and there are some regulatory standards that have been developed on the banking side for the Basel Committee. They also now are highlighting this as an expectation of a resilience program. You need to be able to identify your most critical business services, and these are the business services that are primarily going to be client facing, right? Because you're looking to understand if there was when there is a significant disruption, which critical processes, which critical services are most at risk of creating intolerable harm to any one of the following factors. So they're looking at intolerable harm through the lens of to our clients and customers. They're looking at intolerable harm to the financial stability of the company itself, looking at the concept of intolerable harm to the market integrity. So it's looking at kind of systemic risks and contagion risks, and also looking from a reputational standpoint and from a the Canadians' confidence in the financial services system as a whole. So looking at the intolerable harm to the prudential safety and soundness of the Canadian market. To get there, we need to have visibility into all of the interdependencies across that the critical service is relying upon in order to continue providing and delivering whatever that service is. And so part of the operational resilience, the regulatory agenda, is to put more emphasis on for feasibility to perform that asset mapping. So mapping your people, your processes, your third parties, the systems, the data, facilities, et cetera, all of the key resources that are really critical to enabling that critical business service. As part of this as well, they're looking for more end-to-end. There's higher expectations around integrated and end-to-end stress testing of the most critical business services. And when we say end-to-end, this is also in some jurisdictions, we're seeing organizations and regulators who are asking for organizations to include where they can third parties in the actual stress testing and scenario testing that's being performed, to be able to demonstrate that even the third parties that upon which we rely, that they are able to deliver through disruption and stay within our impact tolerance limits at all times. Lastly, there's an expectation to demonstrate an overall state of enterprise resilience, and this will be through board reporting and notification, taking a risk-based approach in terms of notification and escalation of incidents as they occur, and incorporating those lessons learned from incidents into the broader program. Okay, so when we're talking about operational resilience today, we're focusing on kind of what's changing. Obviously, the regular operational risk management programs are still in place, and the expectations are evolving, but they are separate. We're thinking of those as enablers of an outcome. Operational resilience is an outcome as opposed to the key components of an operational resilience framework. So this graphic is trying to more succinctly illustrate this concept. So if we plot our operational resilience framework with our existing operational risk management programs and frameworks, which are at the bottom here, you can see how the two kind of are expected to work together. So up top, your operational resilience framework is providing an enterprise-wide consistent approach to identifying the critical business services. And here, when we're talking about critical business services, it's not duplicating or looking at the same criteria as is already being performed in business impact assessments in your business continuity management programs. Here, what regulators are really focusing on is on the higher level. It's talking about real significant disruption, severe disruption, and we're assuming that it's already, like the disruption is already kind of past the normal risk appetite or RTO, RPO limits that are in place. I'd say the equivalent of the recovery and resolution planning, that the exercises that and living wills that regulators asked organizations to go through in the past like 10, 12 years. It's at that level of significance. And so it will require organizations to revisit their tiering system, their methodology used to tier business processes and business services, and incorporate this concept of intolerable harm factors into perhaps creating a new level of criticality within that methodology. The resilience framework also, we spoke about setting impact tolerances. So an impact tolerance is very similar to a risk appetite limit or a tolerance statement. However, in those instances, in defining risk appetite, you're really looking at how much risk is the firm willing and able to take on in pursuit of the strategic objectives. So you're in control, right? You're saying this is how much risk we are willing and able to take on, as opposed to when we're setting impact tolerances, really what we're talking about is we're assuming that we are in a disruption. So it's not, how much tolerance do we have for a disruption to occur? We're talking about we're in a disruption. How long can we operate in that state of disruption before the harm becomes intolerable? And by intolerable, and I learned this from my UK colleagues, they were kind enough to allow me to tag along on many of the engagements this past year. Because of the UK regulatory requirements. So it was very eye-opening. And one of my colleagues, he would provide the example in the workshops of distinguishing between harm and intolerable harm. There was a question of a service and whether or not it would be considered to be critical under the concept of operational resilience, if it was a bank client, if a bank's client was not able to if we weren't able to fulfill a bank's transaction, and this was a high net worth client, they were making very large trades, and from the bank's perspective, they thought like this is surely a critical business service, but from my colleague in the UK. And who worked at the PRA that developed their regulatory requirements, he said, look, intolerable harm would mean, that they are going to be their financial stability is going to be at risk, right? It's not about the reputational risk to the bank. It's not about the reputational risk to the client. It's, are they going to be able to survive if this transaction cannot go through? Or does it mean that they just can't buy their third chalet in Switzerland, right? So that was the example that was to put in context what's really meant by an impact tolerance. Impact tolerances are going to be primarily defined as a duration, right? So how many weeks, months, days, like how many, how long can we operate in a very severe disruption? And you're defining those assumptions of disruption when you're setting your impact tolerance. How long can we operate until it becomes tolerable harm to intolerable harm? To support this, you are mapping your critical service dependencies, and we talked about that. The last key component of the resilience framework is you have to be able to test your ability to remain within those impact tolerances at all times. And so this is really about performing scenario-based stress testing to identify potential vulnerabilities in your resilience capabilities. All of this are activities that are going to be familiar and activities that are already being performed in a different context within your existing operational risk management programs. But it's about pulling together a consistent approach to give assurance that our organization, like we have visibility, we understand what would be considered intolerable harm. And we can demonstrate that at all times we've invested in our people, process, systems, controls. We have visibility into our third parties, that we are confident that we can at any moment maintain that level of, we can maintain and continue to deliver through disruption to avoid breaching that impact tolerance. Now, at the bottom, we have our enablers of operational resilience as an outcome. This is the relationship of the existing operational risk infrastructure to the operational resilience program and framework. So we've just provided some examples here. They're not meant to be exhaustive, but you've got existing business continuity, disaster recovery, ops risk management, third party, cyber, incident and crisis management programs, conduct risk programs. All of these things, in terms of the impact from the new regulations that are pending around operational resilience, it's not that you need to change your frameworks. It's not that you need to kind of put these frameworks reporting under the operational resilience framework. What it means is there needs to be more interconnectedness and integration across those operational risk management programs with your resilience program, so that any lessons learned coming out of testing that's performed down in the existing programs, or any lessons learned coming out of actual incidents that will occur from time to time, that those lessons learned make their way into the operational resilience framework. So you're taking those lessons and trying to continuously improve your stress testing and the scenarios that you're using to make sure that they're always kind of cutting edge and pushing the limits, and also to inform calibration of your impact tolerance thresholds. You're wanting to have that continuous feedback loop. And by comparison, you're also going to want any lessons learned coming out of the stress testing to inform improvements and opportunities to continuously drive strengthening of your programs in each of these respective sub-risk areas. So I hope that that helps to clarify kind of what's new and changing on the horizon, what regulators are kind of focused on versus what's already in place and where there are expectations. So I wanted to turn to kind of what's in it for you, and if you haven't already started working, your organizations might be at different levels of design, development, implementation, depending on which jurisdictions you operate in terms of your resilience programs. What we've done is we've pulled together, based on our experience working with organizations across insurance, banking, pensions, like we've been working across many sectors. It's a universal concept, operational resilience. So what we've done is pulled together some practical advice on like what are the key steps involved in standing up and maintaining an operational resilience program. So the first step here is to take stock of what capabilities already exist in your organization. We just talked about the degree of interconnectivity and interrelationships amongst all of these various non-financial risk programs. Like formally take stock of them, go through your, have cross-functional working forums that are put in place where you can identify and tier your existing resilience capabilities, assess their current level of maturity, and to identify, so what can we leverage and where do we need to, have further investment to dial up our capabilities. The second step will be around identification of your critical business services and processes. And I apologize, my children just came home from school. Guys, I'm on a call, please. Shh. So the first step in terms of identifying your critical services is to look at your existing population that should exist within the business continuity management program. And you're going to apply a new lens. Your segmentation of these critical service tiers is going to be focusing on, or including now, this net new concept of intolerable harm. And from practical experience working with organizations, it will take some time to calibrate exactly what that methodology looks like to tier your critical services. By way of anecdote, one of the last projects that we worked on, and it was with a Canadian company who has UK presence. We were hired to come in and help them implement their end-to-end operational resilience program that they had developed themselves. And using their existing methodology, they had identified 32 potential critical services that would be relevant under the operational resilience program. After we performed the validation, it actually went down to only one. And the only reason there was one is because the UK regulator requires there to be at least one. And so I raised this just to give you an idea of the scale of impact and thinking about the nature of the P&C insurers. It's not going to be the same as the banking sector, where they have so many services that across, so many different products that are customer facing. If I think about the P&C world, like claims obviously is going to be one of those critical services, but you should not expect to have more than 20. Like, you should not expect to have that across the board. It's going to be a very small list when you apply that lens of intolerable harm. Then the next step is going to be mapping those underlying dependencies. And so this is where you're looking to understand those where a disruption or a lack of capability in your internal organization or external organization upon which you rely, how will that impact your ability to deliver during disruption? Will it allow you to stay within your impact tolerances? You need to have that mapping done in order to identify and assess the upstream and downstream implications of disruption. Next, you're going to be setting your impact tolerances. And here it's about, I would recommend having cross-functional workshops where you bring to the table the actual risk owners. First line of defense involvement in this exercise is very critical. They are the ones that understand, like, inside out all of the practical step-by-step and process flows, and not just what's on paper, but what actually has happened through prior disruptions. So it's very important that you have them in that workshop to set and calibrate those impact tolerances and thresholds. Once you have your impact tolerances and thresholds, this is where you're going to be testing the organization's ability to stay within them. And so, as a P&C industry, you'd be very familiar with stress testing. It's the same approach that's taken. You're just using operational risk related scenarios and really trying to push the boundaries of your assumptions and validate your assumptions around what you could or could not do under different stress scenarios. And here, this would be the role of risk management and all of the risk officers on this call to help reduce the personal biases that will be brought to the table to make sure that the stress testing scenarios are adequately covering the different causes of disruption, that they have adequately considered different perspectives around the assumptions underpinning what their current capabilities are, like really push the business to challenge themselves around some of those assumptions of what could and could not happen. And then, of course, the regular risk process comes in place where you're going to be putting in place actions to address any vulnerabilities or issues that are identified through that process. Okay, ooh, there we go. I've pulled together some slides. I'm not going to walk through each and every one of these. I'm going to send most of this information to you guys so that you can sit with it yourself, but wanted to give kind of a visual representation and illustration of some of the concepts that we just walked through. So when we think about the identifying and tiering of critical business services, we want to distinguish between a service and a critical process. Service is really going to be a grouping of processes. And so your process taxonomy that's used in your organization, you'll want to make sure that it allows you to distinguish this across the organization and everyone's on the same page in understanding where the focus of resilience is. So the focus is really here at the top, the critical business services. Here are some different drivers of criticality segmentation. So these are the different considerations that you might want to include within your mapping, your tiering of those critical services. And when we talk about mapping of the service dependencies, there's going to be a bunch of assets and different types of resources that sit below that critical process. And here's where we walk through kind of where that where those assets might be mapped to. It's going to be to the critical process level. So here you see there's technology, people, suppliers, data, premises. There could be sub assets below each of these, but essentially if you map these to the critical processes that are enabling that critical service, it's going to allow you to have visibility when there's any type of testing issue through the normal course risk management programs, if there's any external issues that are identified by regulators or internal audit, test results that come back, all of that information will be visible to those that need to see it. And it allows you to be very precise in terms of how you address any vulnerabilities that are going to be that are coming out of this exercise. So this provides you with like an idea of how your existing capabilities with your controls that sit on top of your assets, how all of this works together, right? It's like a big map. That's all that the resilience program is under this new regime. Is it's an overlay and a framework that allows you to use the same language, the same methodology, and the same approach to be able to perform analysis on the information coming out of your risk management programs to inform your state of resilience. Here we're going to be talking about establishing ongoing scenario-based stress testing. The key here is about trying to continuously create new scenarios and not simply rely on events that have occurred in the past. When I've worked with clients developing stress testing scenarios and operational risk, oftentimes there will be someone in the room who kind of calls out, well, you know, how likely is this? How probable is this scenario if it's never happened before? And my response is always, you want to have a certain element. You want to have you want to have a range of scenarios that you are using to test your assumptions around impact tolerance to make sure that you are ready, not to prevent it from happening, but just to make sure that you have considered the art of what's possible and not simply relying on what's happened in the past. I think we've all learned from some of the major operational risk events that have happened in the last 20 years, including the global financial crisis, 9/11, and now this global pandemic, that these things happen, and the things that catch you off guard, the things that you need to be prepared for, are typically unprecedented. So the key here for your stress testing and scenario based work and as second line risk officers is to make sure that you're developing scenarios that really are challenging and pushing the edge of what is considered to be possible. And if we put it back in the context of our knowns and unknowns, it's really trying to unearth what those potential blind spots are in the organization, focusing on the acknowledgement, right? It's not going to be so much focusing on the knowledge and increasing your knowledge of the risk. It's really trying to focus on making sure that we have our eyes wide open and that we are not getting in the way of ourselves in terms of acknowledging what could or could not happen in our organizations. I wouldn't be a good consultant if I didn't talk about the optimization side, the risk value. So that with risk management, it's typically focused on value protection, but there is business value opportunities here through your operational resilience program. When you have this visibility through the service dependency mapping, it's going to allow you to get much more precise around where you invest, right? Where you invest in your processes, in your technology, your people, suppliers, et cetera. It'll allow you to have visibility into the areas that are absolutely critical, where we must invest, we must fund, because it will be tied to your most critical services in your organization, and allow you to risk accept where it's not hitting that level of criticality. So there is a lot of value in terms of establishing the framework, an operational resilience framework that seems like a compliance exercise, but it really does have a lot of business value that it can create for you and your organizations. And it's a good way to sell it to the first line of defense in terms of why are we doing this. Let's do a quick time check here. So we have some practical lessons learned that we've gathered through our execution of, we would call it the end-to-end operational resilience life cycle, right? The playbook, if you will. So this means from the time of identifying the critical business services, working with organizations to perform the service dependency mapping, to define the impact tolerances, to calibrate the impact tolerances, to performing the scenario and stress testing analysis, and through to the remediation planning. And here, these might seem like very obvious, but in our experience, sometimes the process is prioritized over the people aspect in any change initiative. So one, establish a very clear communication strategy. Make sure that you are going out to your organization and making sure everyone understands what's changing, what's not changing, what the impact is, what is the assessed impact for your organization in terms of the amount of work effort, and what type of work effort is going to be asked from the business to participate in the establishing of your operational resilience programs. identify and engage those first and second line stakeholders early and often. And here we have like the second line included with the first line, because obviously there are many second line stakeholders that are going to be impacted by, Tallulah, I'm on the phone.
Rob wants to know.
I'm sorry, that are going to be impacted by your operational resilience program. Clearly define harm factors. So here, with the organizations and clients that we've worked with, they did focus the criteria to segment their processes and their services on harm factors. But the idea of intolerable harm was not as explicitly called out in the methodology as it could have been. And this is going to have huge impact on your program. You don't want to go forward building out all of these capabilities and doing the service dependency mapping, which is going to be very resource intensive. You don't want to do more than you have to. And so really focusing on understanding and making sure everyone around the table understands the concept of intolerable harm cannot be emphasized enough. Prioritize the validation of your critical business service list prior to moving forward with any stakeholder engagement, so that you don't have to go back and ask for information more than once or to redo any of the workshops. In some cases, we had clients who, before they retained our services, they had already deployed their operational resilience program in many business lines, and they had basically all the work that went into identifying the critical services and building up their service dependency mapping and the impact tolerances. In the end, it wasn't going to be used in the final program. Those services were ultimately deemed to be not critical under the concept of intolerable harm. Lastly, prioritize the validation of critical service list and document your rationale for why services are critical or not. So I'm not sure what will happen here in Canada, but regulators in other jurisdictions, they have required organizations to not only provide rationale supporting why certain services are in scope of the operational resilience program, they've also asked for the rationale to defend why other services are not. So that was just a practical tip here. You should also we've talked about the active challenge of organizational biases and scenario testing, and prioritize involvement from the business ops and tech stakeholders. This is really important. I think in some cases we had clients who second line was leading the charge in terms of pulling together their preliminary baseline understanding of the critical services and service dependency mapping. So they wanted to avoid involving business or overburdening the business before the regulatory expectations were understood and well known. And this was a bit of a mistake. A lot of effort went into this, and in the end, the preliminary or baseline assessments that went into this were rejected by the business because it was written from a second line of defense perspective and not from the bottom up and the business owners who are experts in their particular areas and domains. So we really would emphasize, don't underestimate the need to involve the business from the beginning through to the end. They are the ones that are going to own this ultimately. In the end, they're the machine that will generate the data and information that flows up through the resilience framework for second line to be able to provide that assurance and reporting up to the board. So make sure that you involve them early and often. So I can open to questions now. I know that's a lot of information to digest.
Let's take a break here, and absolutely, if there are questions or comments from the floor, this is a perfect time to interject. Alistair, I see, has a question. Let's jump to Alistair, and anyone else out there, just to put up your hand and you'll be recognized. Thank you.
First of all, thank you so much for that. I learned a ton, and I'm trying to think about intolerable risk now. What's too much? But maybe just to back up a little bit, in a lot of discussions I've been having with folks who have just been managing their companies through COVID, they're kind of regarding this, I don't want to say smugly, but with some confidence as a result, that maybe it was on the edge of known unknown or unknown unknown, but it was a severe curveball. And our industry was able to maintain customer service, broker service, and had policy wordings that have held up pretty well to the claims that weren't covered, and had capital and reinsurance more than adequate for the surprises we've dealt with. And so just in terms of a kind of a reality check on our industry's resilience, people are feeling okay. So how do you help organizations think about why they shouldn't feel that good about their current footing? And how do you get people to think creatively enough, frontline all the way up to board, about what those scenarios might look like that lead to intolerable harm?
Absolutely. I mean, first I would say, I don't think that anyone should feel not okay, because the pandemic, actually the lessons coming out of that showed that firms had invested very well in their, especially firms that have already started on their digital transformations, right? Their digital strategies. They actually were able to flip to remote working fairly seamlessly. And so I would say the idea here around what's new or what's being asked in addition to what's already been done is really about putting a bow around it, right? It's putting some formality and structure so that even though we went through this pandemic and most organizations had the ability to even move, like traders, wealth management advisors, everyone was moving back to remote working, it doesn't mean that the next time it will go the same way. And I think that that's really the message that regulators are, and I'd say boards are expecting of their organizations is like, let's just avoid complacency and get that assurance to continuously push ourselves to avoid sitting back on our laurels or getting too smug. I liked your word, too smug, because I mean, I don't work at OSFI, but I did for 13 years, and I did through the global financial crisis. And I can say that there was some smugness and complacency months even before the first signs of that crisis occurred. And it was around funding strategies, right? Where there were organizations that were very reliant on wholesale funding and ran into some troubles when the asset-backed commercial paper kind of dried up. And so I guess the idea here is to say the evidence of the past of how well we survived and worked through events and disruptions that have occurred already is not necessarily the best evidence that will support our ability to go through the next crisis or the next of this scale. I mean, right? I'm talking here about like magnitude, like industry wide events. I don't know, Tracy, if you have anything to contribute to the question.
Yeah, so I think there's a couple key points that I got out of what you were talking about, and particularly you talked about kind of putting a bow on it. These are a lot of things we're already doing in other aspects of our program. So we do BIAs as part of our business continuity. This is taking it a step up and taking it to the framework level and doing it holistically. And taking this other perspective, not from our business operations level, but our key stakeholder view, and taking that slightly different view, taking a step up and critically assessing at a very significant level of materiality what is critical for how we need to operate. And I think when we do that and you've got that all hazards view, then when you have those unknown actually become known knowns, you can take you've already got processes that address those all hazards, and you can pull those processes out and take action on that, right? So I do reflect back on, the early days of the pandemic. Your point was, our pandemic plan considered, regional pandemics, individual offices, failovers. It did not anticipate a global pandemic where everyone moved home. But we did have many plans that were all hazards that said, okay, what are we going to do? And we had processes that we could leverage. This is taking those same lessons learned, to your point, and applying them to a larger model. So, I think there's lots of what we already do that we can leverage to help meet these requirements when they come in place. So, and fortunately, we've got other jurisdictions like the UK that are already doing, and we can learn from what they're doing.
Yeah, and they, one aspect, that we've seen working in EY, working across all the jurisdictions, we have like a resilience forum that we connect to see, especially during the pandemic, we've been meeting very frequently to get observations on how organizations have responded. And in those early days, there were not everyone had an easy time. Like it took a lot of what we would say individual heroics and the organization's culture kind of pulling together, right? That allowed the organization to avoid disaster. So it wasn't something where everything was formally understood and in place, and we're just pulling this lever and then we're pulling that lever. Like the culture of the organizations and individual leadership and heroics and the organization's ability to adapt, right? And communicate and have a cohesive, aligned approach of responding, like that. Don't underestimate the importance of that aspect. And just to connect it back to what Jackie was saying in her keynote, which was awesome, about the culture risk framework, right? Like one of the outcomes of that they're looking for organizations to demonstrate and to have an ability to monitor is operational resilience. Like how resilient is your organization? Yes, it's easy to say, we went through a global pandemic and we made it. So, that's pretty good evidence. I've heard that a million times from so many clients. Like, that's the best evidence, Catherine, is that we made it. But how do you demonstrate that on an ongoing basis? And how do you continuously keep ahead of any potential changes to your organization's state of readiness? Like, that's really what this operational resilience the framework is looking to do. It's looking to monitor how well we're managing all of our operational risks and to enable the outcomes that we're looking for in terms of being resilient, easily adaptable to change. I would even say, like, when we think about resilience and operational resilience, there's factors that are outside of operational disruption that could be leveraged here. Like we could apply it to competitive disruption. And I don't know if that really is as applicable to the P&C industry. I haven't heard too much about major disruptions from fintechs in the P&C sector, but this idea of making sure using your operational resilience program to drive a certain awareness within your organization and mindset, right? I think it's a very powerful and valuable evolution as a risk nerd, I'm very excited about it because I think it makes a lot of sense. Any other questions?
Yeah, are there other questions or comments from our viewers out there? If there are no questions or comments, we'll probably look to wrap up now. Okay, and I don't think there are. So thank you, you two, for just dealing with the last minute hiccup. I know that completely turned your world upside down in terms of the slides you were going to show and how the discussion was going to go. So thanks so much for that. I think you have ice in your veins to deal with a presentation and kids coming home from school at the same time as.
Okay, this is recorded too, right? So I'll be able to play it back to them and show them. Okay.
Anyone with home office, it is the intolerable harm that that can come. I'm just kidding, but there's always that risk. So that concludes our second hour. That was Katherine Macpherson from E&Y Canada and Tracy Mann from Definity Financial Corps, talking about operational risk and operational resilience. We had earlier the first panel was Donna Sirmons from the Florida Hurricane Catastrophe Fund and Dr. Jack Nicholson, consultant with Catastrophic Risk Consulting, talking about model risk. And of course, our keynote was Jacqueline Friedland from OSFI, talking about current industry risk issues. And I'll maybe ask Grant if you could flip up the, for everyone to mark their calendars before we sign off here. We have a climate change modeling emerging risks webinar coming up on Thursday, May 19th. You will see that shortly. The registration forms are coming out for that very, very shortly. And then the last risk webinar of the year is going to deal with privacy, managing compliance and reputational risks. Again, that is Thursday, October 20th. And then there's two more forum meetings to close the year. Thursday, September 15th, we're going to have a CEO deliver CEO perspective on the risk function, finding balance with regulatory risk. We're going to talk about inflation risk and also human resources and talent management, which surfaced in today's discussion with Jackie. And then the final Risk Officers Forum meeting of the year is we're going to try to twin it with OSFI's risk management seminar. They went to kind of a more full day format last year, and we did ours the next day. So whenever they peg their date, we will probably be the day that follows. We're going to hear from our PACICC board chair on a review of our strategic planning conference, which is taking place on June 9th. And we're going to be looking at what PACICC does and the path forward. And we're also going to look at class action status and update and supply chain risk. So that is it. You're going to see a satisfaction survey. I think that's going to be our last slide here. I'm coming back to everybody that registered today with a satisfaction survey. Your questions and comments help make for better broadcasts in future. Thanks for being part of this today. I think that was our biggest event ever, and most number of people signed up and most companies involved. So thanks for being part of that. You're now heading into a long weekend. I hope you enjoy that, and watch for next week the registration forms for our next event to the webinar on Thursday, May 19th. So signing off for now. Thanks for being part of the broadcast, and we will talk to you soon. Take care.